first thing to say is when you speak to people about, like, there's a ton of confirmation bias, right? And I think, but I'm 30 now. I think my general understanding of the world at 20 relative to now was 0.
But what you said was a lot of these funds can be kind of shit. If you are passing on 195 of 200, why? What is it that's shit about them? And please don't hold back.
Cash back to investors matters. Why? There's a lot of funds sitting on very nice chunky paper returns right now.
Yep.
Doesn't guarantee anything. I think it's one of the other reasons why I was so eager to start a business, right? Is like there's a lot of industries that just gate based on time and experience, not quality and not skill. I think M&A in general is probably a higher standard of speed and precision than anything else I can think of.
What you gain from skin in the game is a complete new and different skill set and perspective and view on risk and life generally compared to being in the corporate world.
If you take any given angel investor, right, like you guys have been investing for a while now, deal flow is king. You can be the best diligence in the world, but if you just look at crap deals, you're going to do crap deals. Part of investing in the funds rather than being an angel and building a basket is you can build a basket with 100 bad startups, or you can build a basket of 50 startups with professional level deal flow, full-time DD.
And I think that's all the formalities out of the way. Sprout.
There we go.
Viasprout.com. I'm all about domains. So like, he's like, why do you put rationalvc.com everywhere and not just rationalvc? I'm like, because you need to direct people to the funnel and sign up.
Yeah.
It's not that. It's that you write a comment on LinkedIn where you're just, replying to someone's
Totally
thing,
unrelated. I'm like, yeah, interesting perspective. Rationalvc.com.
Like 50 Cent.
50 Cent does this with the hashtag, his champagne headphone brand.
Le chemin
Yeah,
de roi.
exactly.
I was like, what is that?
And we're live, rationalvc.com with viasprout.com, and we have some wonderful merchandise here. And where do we begin? So in the UK market for several years, I've of course been aware of Entrepreneur First EF. And then a few years ago, we became aware of Odin, our friends, and other players. And a couple of years ago, I started hearing Sprout this and Sprout that and Sprout this. And last year, I was speaking to a friend of the show, actually, Alex McDonald, who is a very prominent angel investor, operator, founder in the UK. He does a lot of angel investing with a very great track record. And I was just having a chat with him last year, catching up on a Zoom call. And he said to me, Cyrus, the one deal in the entirety of 2022 that I regret missing out on was the Sprout pre-seed. And when that comes from Alex McDonald, that tells you something. So then you got to start looking into it more. Iman actually has known Jonny. I'm gonna give my version of introduction to you, and then we can hear more from you. But Iman has actually known you for, I believe, just over 10 years through mutual friends. And then later you both joined PwC and then Strategy which I can maybe picture as the elite or exclusive arm of PwC, where they send off their smart people or very talented people as well. And you both then worked there for about 7 years. So you further let the relationship compound, and I'm all about these, these optimize these nerd terms like let the relationship compound, just like interest. And so, we like to bring on or further look into people who we already have an existing relationship with and just see how they're doing. And as I said, Entrepreneur First, Odin, other players, and then I guess the final third of the market that had not been captured yet. And me and you had always spoken about, we're like, there's this gap in the market, I wonder who will address it, is Sprout. So we have the exceptional Jonny Blausten. Welcome to Rational VC.
Hello. What an intro. I feel like the pod's got a lot to live up to now.
I get that a lot. Everyone asks me, you should come on the road show, you should be my hype man, you should... But, we have some big fees at Rational VC if you ever want to hire us, so we can discuss that off air.
I'll bear it in mind.
Please. We have some Iranian rates, which is,
dodgy rates, yeah.
Dodgy rates. But anyway, I guess I want to kick this off with who was Blausten as a kid. We don't really care about the last few years. We know that. Most people can check your LinkedIn, whatever. It's pretty cliche to say what was the last. Tell us about your childhood.
Wow, okay. The real backstory. So it's relatively boring. I was born, raised in London, North London. Went to school, as a lot of people did. I was quite a kind of cheeky, chatty kid, was good at school, well-behaved, did well at school, kind of didn't love studying for studying's sake, but found it quite easy. I had an early interest in business, loved sport, kind of did did all those things kind of outside of school on the side. You know, the whole like, this is gonna sound made up. I promise you, it's not like, you know, got caught selling my tuck when I was like 8. Like my mum, she was like, I keep giving you more and more biscuits. You always get through them. But yeah, so I was like this cheeky kid at school, did quite well. Difficult to think about kind of what I was. I don't know. I didn't really know me back then. But
That's a good one.
yeah, kind of sociable, liked people, quite chatty, but also not that like, I wouldn't say I was overconfident. Always kind of knew I wanted to work. I actually kind of wanted to work from an early age. Although I had no idea what I wanted to do. I just wanted to do like business. Went and did economics at uni, and kind of the rest went from there. I guess at uni, I'm going to use the phrase founded really loosely, but like started 3 businesses, all in a different space. Actually, a couple with kind of similar themes to Sprout. First one was like, I'm going to get the order right here. First one was like a fashion related business that was like about giving kind of up and coming designers a bigger platform. It was called Renegade Design. Didn't last very long, but the idea was good. And it was so my co-founder was at uni with me. He then went and worked in like Armour Partners. A guy called Danny Chung went to Grafton. He was at as well for a bit. And then went and did some stuff in the crypto space in America, which, you know, he's now back. And
Been there, done that.
yeah, but the idea was like, look, you know, you're an up and coming designer who's unearthing that talent. It's kind of really hard to find. There's probably some really great minds all around the country. Can you create like an umbrella label that essentially scouts these people, lets them design, and then earn a kind of share of commission? So that was like number one. Didn't really go anywhere because I had absolutely no idea how to start a business, but like big idea to have first year of uni without any idea how to raise or do anything. That kind of splintered into the guy who we brought in to kind of be the creative side of that, because I'd like to think I'm on like the creative end of business people, but I'm not a creative, which I kind of realize every day at the moment. Splintered into what actually was just more of a fashion label called Staple with the Cool Kids, where I ran the business side and the creative guy ran the creative side. That did better, lasted like 6 months, 9 months, broke even, closed it down, had some fun, you know, working like on a market stall, getting up at 7 a.m. to go to like Brick Lane and sell clothes. That was quite fun. And then also probably the closest one to Sprout, which is quite fun and I still think was a good idea and ahead of its time, was a business called And I'm In that we had, a terrible name, that we had in like second or third year of uni, which was the idea of like, people want to go clubbing, people want to go on a table, can you just buy like 1 seat on a table or 2 seat on a table, and kind of the business takes a seat and kind of a table and a
arbitraging social proof.
Yeah, so that was what,
Winning.
I don't know, 11, 12 years ago. I think there are a couple of businesses doing it now.
Are these businesses a reflection of what you were interested in at the time? So you basically just were interested in fashion and clubbing.
You wanted to be the man in the club.
Yeah.
Or in the garms.
Yeah.
You were basically sort of, you could say, an Aubameyang of your time, the Flash man.
You won't be surprised to know I've never described myself as that. But yeah, like, I guess they were, right? They all reflect, and we'll come on to Sprout, obviously, but I think there are a lot of people who want to be entrepreneurs, and they've decided they want to be, and they've decided they're going to start a business, and they just brainstorm ideas, and like sometimes that works. For me, like the most authentic and the best businesses come from when you're solving a problem you face yourself, right? And especially if it's an industry you've worked in, but it could just be something you've got a passion about or a hobby about, and you actually understand, because you're going to understand the pain points of the customer much more. And yes, it happened that like my pain points at uni were like, I want to go clubbing, and you know, I quite like clothes and whatever it was. But yeah, I guess you could say that they were kind of along those lines. They were little, I don't know, the problem solution, right? They were the problems I'd identified, and they were little ideas to solve them. Learned a lot. I think that does mean that technically Sprout's my 4th business, which is great, because I think that improves chances quite greatly of succeeding data-wise.
Yeah, it's what
And yeah.
VCs want to hear.
Exactly.
Of everything you've said, the one
Serial
thing,
founder.
Of everything you said, the one thing I want to just quickly rewind to is you mentioned Brick Lane Market selling clothes or something. Can you touch on that quickly? Because I think, to me, that kind of, whatever you want to call
Hustle.
it, wheeler-dealer hustle is the most important part of the journey.
Yeah,
Can you
and
shed some light on that?
yeah, it's interesting, right? Because there's and we'll come into kind of what I did professionally after, right? And actually, when I look back, there are a number of things I've done in my childhood and when I was a student that have probably helped me and through kind of other interests I have, which I know you've got on your list of questions that have helped me in terms of the ultimately sales side of what we do, but like being confident in front of people, being able to speak, etc. So I worked at a summer camp when I was a teenager. That involved, standing up in front of kids who were probably 8 years younger than me, but having to communicate with authority and give instructions with clarity. Presentations at the end of the week, right? Holding your own with parents when their kids were like nightmare and you were telling them that their kids were a nightmare and they're like, no, my kids are an angel, and you're 16 and you're like, actually. So there's all that. And that came through to, when we were with Staple for the Cool Kids, same thing, right? Like, get up. It wasn't Brick Lane Market, it was like Truman Brewery. It was something around there. I can't remember what it was. They had like a space where small brands could take a stall in the morning, and we had some kind of samples of clothing, and literally like get up at 6 a.m. or whatever it was. That is not an don't test me on what time it was. Turn up on a market stall with a bunch of clothes, and like you've just got strangers coming to you all day, and you have to tell the story. Same as pitching as a founder, right? Like tell that story again and again and again, and hone it and perfect it and see what works, and have like no issue going up to strangers. I feel like I could say I've always been good at speaking to strangers and starting conversations and whatever. I probably haven't. You just acquire it over time. I'm sure I'm naturally talkative, I'm naturally chatty, but I think that kind of confidence in I'll speak to anyone, I'll say anything, I won't say anything, that's not what I meant. I'm comfortable saying things. I guess that does come from experiences, but they layer on top of each other, because once you start doing it, you become more comfortable. The more comfortable you are, the easier, you're always the one that's like, I'll do that. Yeah. I'll pick up the phone to that person.
It's
I'll
also
go have
the
that
street
conversation.
smarts as well. The whole market thing is, I think street smarts, it's not, people don't put enough emphasis or focus on that.
It's undervalued. I agree. It is undervalued.
I remember a founder that, no names mentioned, but he said to, we were discussing, I was like, yeah, I rate people with street smarts the most. And he was like, oh no, I would never want my kid to go to, he was like, I want my kid to go only to be like to the most elite school and not interact with any of like society, because why would I want him to do that? And I was like, you just don't understand. You don't get the point. You need the wide array of perspective. So I think you've had a great perspective anyway.
What did your parents do?
Wow, we're going deep. So my dad worked in property. His dad worked in property, and he worked with his brother. So he was surveyor by trade and also did kind of property services, etc., etc. And my mum's a nurse, so she's a senior neonatal nurse. So like
Thank you to the
super
NHS.
super clap for carers, super like premature, like super like really premature babies. That's like my mum's specialism, and she was a midwife before that.
Did you not want to go into property yourself?
I thought about it, and like honestly sat here, it probably would have been the easiest route. I'm too interested in business. I think it's always been something that you can kind of go into eventually. Like a lot of people make their money, have their careers, and then go into property. I think.
Would you say that it was not intellectually stimulating enough for you as this game is?
I never saw it like that. I think the challenge for me was more that I think you've got to do a lot of the qualifications first.
Right.
I think in the same way that one of the things that put me off doing a CFA or doing an ACA was just like, I've wanted to work my whole life, right? I've gone to uni. I don't want to now go and do like 3 more years of exams, whatever else. So yeah. Property in particular, like the route everyone tells you to go down is go and get, I forget the name of the qualification now, right? But go and get your surveying qualifications, right? So it's another year or more.
RICS, I think.
Yeah, go and join the RICS. Do your exams, train as a surveyor. I'm like, but I just want to develop stuff. And they're like, no, you've got to go down this whole long route before that, and that's how it works. I'm not a huge fan of kind of industries that, and I think it's one of the other reasons why I was so eager to start a business, right? Is like there's a lot of industries that just gate based on time and experience, not quality and not skill. I was quite keen to kind of avoid like this automatic trap where it's just like, yeah, you've just got to do X number of years before you can do anything in this industry. It's like it's set up to kind of just delay success unless you have an in or you're lucky or you have someone who helps you kind of accelerate that. I still like property, but like I just like looking at nice new buildings, right? Like that's kind of the be all and end all, and I know you can make a lot of money in it, but that's what excites me about it. It's not something, it just doesn't get me excited in the same way as and I know business is like a big broad term, but the world of business.
It's interesting because yesterday I think someone posted on Twitter, why is it that UK LPs don't think in the same way as LPs in the US. And they gave the example that the majority of European funds, venture funds, have more money deployed in them from US LPs versus European LPs.
Mm-hmm.
And part of that is probably this protectionist mindset that's emerged from basically people wanting to keep their money and not want to take risk with their money. And I think that's largely driven by the real estate market in this country, at least, which is you've seen, 30 years of ridiculous returns on 40 years of ridiculous returns on property. And so actually it's a safe haven, but it's also a way of realizing returns that could be in the 20-30% per year. So I don't know, I think that's kind of skewed the market. But now that the property market is probably slowing down, well, that's even debatable in and of itself. But in that scenario, it seems as though the pendulum should swing. And in us sort of doing our fund work as well, we've seen that LPs are a lot more risk averse in this country than perhaps in the US. But I digress. Let me come back to you. The interesting thing is you then went into consulting, which is where we obviously got to know each other a little bit better. We kind of slam people for going into corporate too long, which is ironic given our backgrounds. But
I think they're all deranged, but please continue.
The difficulty in looking at this from sort of in a mindset of you can't really learn anything in corporate, or if you stay too long you're fucked, or whatever. What did you learn from going into corporate? Maybe explain a little bit about strategy and the deal type of work you were doing.
So I think first thing to say is when you speak to people about, like, there's a ton of confirmation bias, right? And I think the more I'm 30 now, I think my general understanding of the world at 20 relative to now was 0. And like every year you learn more, right? You learn more about your parents, you learn more about like other people's parents, you learn more about like what you perceive to be true in the world. And I think, confirmation bias just creeps into absolutely everything. So I was speaking to someone yesterday about like a lot of the way and kind of lived experience, right? A lot of the way that kind of people's parents bring them up, you grow up with these values because your parents have just told you this is how the world is. And I think that kind of, we all know that and we all do it. So people who have never worked in corporate will tell you why like getting a job in a big corporate is like stupid, but you're only hearing from the people who have made it. And the people who have started their careers in a corporate and then have made it, like, will tell you why it was the best decision they ever made. And the people who have stayed there, like the number of people that we hear who have been there 20, 30 years, they say, my biggest regret is never leaving. So
wait, objectively, what do you think made it means?
I don't think there is an objective made it.
Okay, good.
I think it's subjective, right? It has to be.
I'm similar to you guys. My perspective is I've done it. That's why I say it. But like I got the 2-3 promotions, whatever levels up, and then I was like, I've kind of reached the ceiling of learning, and I pulled the managing director into the room, who is one of only 2 people who I still have great respect for based on their work rate, hustle, intelligence. I pulled him into a room. I said, look, apart from you, I look across this entire floor, not a single person here inspires me or I want to be like them. And that was part of
Send all to the whole team.
It's the truth, though. I mean, with all due respect, and there's nothing wrong with it. A lot of them will look at people I admire and they're like, they don't inspire me. I'm like, cool, each to their own.
Sure. And I think, like, I don't disagree, and I didn't have like enormously dissimilar feelings, but I think, and I'll come back to the story because you asked a good question. That's a different point for everyone, right? Like some people have that 6 months in, some people have that 10 years in. And for me, like the kind of lesson I've learned is it's about going in and being open-minded and know what it would take to leave. So I joined Strategy. So Strategy, and for those who don't know, used to be called Booz. It was one of the kind of big 4, so it was McKinsey, Bain, BCG, Booz. PwC bought Booz to improve the quality of its kind of in-house strategy consulting team. We were all very snobby. We thought we were better than everyone else in the company.
I put that as part of the rational bio pitch because it was he wrote his bio, I wrote my bio on our website, and then he was being quite humble and he said, Iman works at Strategy, and then I went in and changed his bio. I said Iman joined PwC and then he was transferred to the elite top 1% arm of PwC, Strategy.
It's funny, although like the branding still hasn't built its kind of place in the market yet. And actually, like the more I go out into our world, the PwC brand is still way stronger. Like fewer people have heard of Strategy. Anyway, so I joined out of uni, like smart, with a brain. I could think. I was commercial. I was full of energy. Didn't know how to channel it. Didn't know how to structure my thinking. didn't know how to communicate in a kind of measured and structured way. And I was like, I think my early feedback was like rough diamond, right? It's like, just point me in a direction and I'll like do good work, but also like there'll be a mess and I'll forget stuff and my attention to detail's not there and all this other stuff. And, over the first like someone else said to me, and it was really useful advice, someone was like, expect to be shit for the first 6 months in the job. It was actually really nice to hear, because I was.
We all are.
And over time, you develop the structure, you learn more about yourself, you learn what your strengths are, and it's in a safe environment, right? And like that's good for some people, it's not good for others, but you get exposure to you're surrounded by really smart people, and actually the standard of people in that environment, because we're working with and for some of the best PE firms in Europe, is substantially higher than in kind of the real world. So you are working alongside really smart people who are testing you and asking you difficult questions every day and pushing you to work faster and harder and with a level of accuracy and detail than like the rest of the world works to. And I didn't realize that until I got out of it. But and I'm not just saying our company, right? I think M&A in general is probably a higher standard of speed and precision than anything else I can think of in kind of career terms. And someone's probably going to tell me that I'm missing something, but
you could argue law is similar.
Yeah, but in particular corporate and M&A law, right? Yes. Like it's that world where you're just being beaten up by smart people who are like, I'm paying you loads, do this, and it's difficult.
Yeah, I mean my experience is the same as yours from banking. I agree that I went in as like a just completely no idea of how to carry myself in the corporate or professional world, and it's all carried over to everything we do now and many other things. So my advice is always, because we have a lot of mentees and kids who come to us for advice. We run the community and stuff, and I always tell them, he says the same thing, it's like, do a few years, because you will learn the business skills, you learn how to maneuver in the big corporate world, you'll become polished or whatever, and then leave. But the issue is that most get stuck in the golden handcuffs. So,
which is interesting, right? So I always thought I was going to leave. I always thought I was either going to do something interesting or start a business, maybe go into PE. But I was like, I'm going to do this for a year and leave. And then after a year, I'm like, I've just got the hang of it, and I'm now doing really well, and I'm now doing really interesting stuff. And what I'm doing, I've gone from being the baby to now managing people, and actually this is a useful skill to build here. So like the technical skills have peaked, but some of the kind of organizational and management skills and like delivery, right? We talk about being an operator, but the ability to deliver stuff, that's what I'm learning now. I then seconded, I went to live and work in New York for 6 months, which was amazing. Came back, bought my flat, so there were some financial reasons. Suddenly, you're 4 years in and you're looking around, you're like, oh shit.
Yep.
Like I thought I would stay here for a year and I'm now 4 years in. So I did want, and I always wanted to move. I interviewed for certain things. I was really fussy, but I never wanted to leave for the sake of leaving. My one thing I wanted to do is I saw a lot of my peers leave before me, and like, to be completely honest, go and do things where I'm like, that's not worth leaving for, that's not worth leaving for, that's not worth leaving for. So the one thing I said, I was like, I'm going to make sure I keep developing and doing things that interest me. But when I want to leave, I will keep looking for opportunities. I will keep interviewing for things that are interesting or meeting interesting people. And there were a couple of things, I had an interview for a strategy manager role at Arsenal, as an example. Talk about golden handcuffs. It was a 50% pay cut. I was 5 minutes into the interview. He was like, this X, Y, Z's the pay. I was just like, I want to do it. I don't want to do it this much. And we just ended the interview. Now, that's the situation you get into, but some things are worth moving for and some aren't. I think I was quite lucky. I did some really good stuff in tech, did some like a lot of software deals, but I made, towards the end of my time there, I spent a lot of time and effort trying to work on the things that interested me outside of work, because that was what really, I was like, I know what I'm doing. I find the job quite easy. I find it quite, like, I'm going to pursue stuff outside of this, but I'm going to find, at least if I'm doing this, I'm going to do subjects that interest me. So I kind of anything that was gym related, sport related, fashion related, I was like, I'm doing that. So I worked 2018, worked buy side on the Newcastle United deal. 2020 worked sell side when General Atlantic invested in Gymshark. Did a bunch of other D2C e-com stuff, and also again, and we'll come back to, like, taught me a ton of things that I'm now using in my job about customer acquisition, channel strategy, power of brand, power of community, and then all the hard, like, analytical stuff underneath. And I guess most recently worked on kind of post-deal stuff with Newcastle as well. So that was kind of, if I'm going to leave, I need to leave for something that's worth leaving for. And whilst I'm staying, I'm going to make the most of it and learn as much as I can.
Let me just add a little bit of context to some of the work you were doing. In consulting, typically what you do is you go and support, there's two buckets, you could say. The first bucket is you can go and support corporates to become efficient across different spectra. And what that could look like is maybe going and designing a new op model or thinking about their strategy in terms of entering a new market, new pricing, new customers, all of that good stuff. Equally, there's the tangential part of consulting, which is what you predominantly focused on, which was the deal side, which was around due diligence. So commercial due diligence in particular, which is looking at the commercial drivers of a business, both on the sell side, so whether you want to sell a business and tart it up for sale, or for the buy side, so you're supporting a buyer to go and look at that business to buy it, and then you're really diligencing the numbers to see if it actually, the valuation makes sense. From my perspective, in 2 to 3 years, maybe 4 years or so, you can probably pick up a lot of the relevant skills that you need to think about commercial due diligence, how to think about businesses, how to measure them, how to value them. But the thing that's really interesting about corporate life, particularly the more senior you become, is that you get access to people that you otherwise wouldn't have got had you not built the trust with your team to stay at that company long enough. So what I mean by that is on the more sort of soft consulting strategy side, we'd go and maybe work with one of the leading companies in the world, and you sit in a boardroom with the CEO, and it's not the fact that you're in the room with the CEO, is that if you have enough nous, you can understand how the most important people in the world think and how they then communicate on the basis of that thinking. And what's really interesting is the fact that the one thing I've picked up is how quiet these people are. Like, it's actually insane when you think about it, that they very rarely say a word. They take as much information on board as possible before making a decision. But when the good ones, when they do make a decision, it's final and people listen to them. There's no consensus in this world. And I think that does a lot for you in terms of leaving and understanding how the most important drivers of value people think. And if you're going out and maybe raising capital for your new business, or maybe you're creating a new business, you know how to talk differently to different types of people. And I think that it takes time for you to be trusted both in the boardroom on the client side, but equally by your team to get the opportunity to be in those boardrooms. So whether you're an M&A in law, whatever it is in consulting, there is always, it's a positive sum game. It's not zero sum in the sense that if you stay long enough, you're kind of handcuffed and you can't get out. But equally, there's a tipping point where you have to think, okay, how much have I learnt on the non-intangible stuff as well before you then end up leaving?
I think 2 to 4 years is a sweet spot. After that, it's diminishing returns. And you need to actually get in there like you've done now. We quote a lot of Talebian terms, take a shot every time we say skin in the game. But you've genuinely, you've got ultimate skin in the game now. So I think what you learn from, and you can probably talk to this, but what you gain from skin in the game is a complete new and different skill set and perspective and view on risk and life generally compared to being in the corporate world. Not to say the corporate experience isn't valued. It's, as we've discussed, do it, but 2 to 4 years. But to really wrap this whole thing up, I think you are an anomaly, because people like yourself, or when I was in corporate, I think we are anomalies that we spend our free time on side projects or various things. Most people say they want to, but they don't. And they just hit the pub after work or whatever.
So I think one of the things that I didn't really appreciate as much as I could have is that applying for jobs you can do with limited time around your work. Building an opportunity, right? That's why one of the reasons I like America is because everyone's got a side hustle, right?
Yes. Yeah.
To build that opportunity, it takes time and it takes kind of hard work. And now I'm out /in, depending on which way you look at it. Now I'm doing what I'm doing now. I have time to make my job is to create opportunities for Sprout, really. And that's a full-time job. And what I appreciate with hindsight is that one of the reasons you're paid so much in M&A is not just because you're giving up a lot of time and it's high-value work. It's also because you're essentially selling your opportunity cost.
Yes.
And it actually creates a situation where it's very hard for you to open up the highest value exit opportunities. You can go and apply for jobs, but the best exits are either side hustles or a relationship you might build with someone who offers you something or is building something. And that requires you to take the lunch, to go for a coffee in the middle of the day, to go for dinner. And if you're not doing those things, there are other ways, but you need to figure out what your way out is. And to Iman's point about kind of the people you're in the room with, one of the other really good exits that you do see is when someone gets a bit more senior and then someone they've met through a client does something and offers them. So it might be that actually if you're not doing it when you're more junior, then potentially you're showing your value, you're showing your talent to someone who spins off and does something and picks up the phone to you in a year or two.
Yep.
But for me, the thing I would say to people kind of in the corporate is go and learn everything, go and take everything, right? Like, you don't owe them anything. You owe them, they've given you a job. You go and work hard, go and work as hard as you can, learn as much as you can, but just go and create opportunities. And that could look like anything, but it involves meeting people. It involves speaking to people. It involves having hobbies. It involves being sociable in work, but outside of work.
Cool. Well, I've said to wrap this whole thing up twice now, but to really wrap this whole thing up, my advice to add to that as well, which is excellent advice. Mine is two things. One, read the Inserter series by Nassim Taleb for a slap in the face. And number two, just go and do shit, because you'll make so many mistakes and fail so many times that you'll learn so much about real world perspective. But the whole point is, because you have your job and salary and stability and security, to be having side hustles, you basically have a moral obligation to have side hustles, because it's asymmetric. It's a low downside, potentially high upside, and it's a no-brainer. You have to be doing it, especially with now like all the fear mongering around AI. But okay, eventually in a few decades, AGI or whatever. But a lot of jobs will eventually change or be automated in some way. And so if you don't have some side hustles now, like Matt Ridley talked about this in The Rational Optimist over a decade ago, Lord Matt Ridley, I must say, and he's genuinely a lord in House of Lords. It's not one of those like fucking Lord Disick or whatever the hell. He's not an influencer. He is actually a lord. But anyway, I digress. As Matt Ridley touched on over 10 years ago, Rational Optimist, he was talking about how eventually, look, a lot of the automation that takes place, creativity is the last frontier. You could talk about UBI or whatever, but okay, creativity is the last frontier, and we will get paid for our creative output. And so people who are ahead of the curve, blogging, podcasting, venture-backed startups, whatever, something that, take a shot, as Naval talks about, like chase the leverage, code, media, or capital. You're essentially doing all three, which is extremely interesting. We'll get onto shortly. You're the maximum variance amplification, as Jim O'Shaughnessy says. But just do shit. Just try a lot of things. It's asymmetric. You've got nothing to lose, because eventually you may be replaced, or people we've seen 10, 20 years in their jobs, they've been kicked out recently in all the layoffs. So you've got to have a portfolio of small bets on the side that eventually can turn into something, and it's a very low risk way of doing it. So I totally agree with everything you've said. Let's move on. We just touched on Sprout. We want to discuss a lot about Sprout. How did you come up with the idea for Sprout? Because we have felt this pain point for a while. I'll give you my short picture of what Sprout is, and then you can add to it, because let's say I'm a consumer. I've seen it in the market.
Let's see how well we've done.
So retail customers, not just retail, but a lot of people, including retail customers and high net worth individuals, they want access to startup investing. The problem of startup investing, as we do syndicates or many other, structures, whatever, for investing in startups, the issue with that is every time you're investing in a single startup. So it's extremely high risk, and it's got to be the pots or the 10% of your the barbell strategy you want to talk about, that you're willing to completely lose or gamble on. Now, a lot of people are like, I don't want to gamble. I don't want to invest in one or two or three. I don't want to pick individual startups. I don't want to lose my money, because statistics say you are probably going to lose your money. Most fail or do not do well or barely return. So you're like, okay, but is there index investing for startups? Can I invest in a basket of startups? Just like on Vanguard, you have an index fund of MSCI World Index or S&P 500 Index. Do you have that for startups? We looked for a long time, because we like to have, hand in many pies, finger in many pies, as they say, and we didn't find that. So Sprout came along, which basically said, we have a team, and this is not a pitch, but it is the truth, given the background in like all of these firms, such as PwC, and your colleagues are also PwC and ex-private equity. You guys are, for a living, for combined multi-decade experience, just banged out non-stop diligence and decks and been in deep Excel financial models and so on and so on. So who better to vet? And also one of your co-founders, I believe, was head of PwC Raise Ventures.
Yeah, Rich,
which is the venture accelerator arm of PwC. He co-founded that on the founding team. So you muddle up, you combine all this experience. You're like, shit, who better to actually diligence funds? So then what you guys do is diligence many funds to pick the top tier ones. And we can get onto that, what that means. And then you allow people for as little as 5K to invest in these pre-selected funds, and their money just goes into a basket of startups, which is like an index fund. It's a way of investing in startups with lower risk and potentially higher returns, reducing the risk and gaining access to deals they otherwise would not have access to, because you need the network and the big capital, and they're usually oversubscribed, and historically it's an old boys club, or you need to have the right contacts, or you need to be mingling with the fat guy in the Ned or whatever. The game's changed.
Don't know if VC people pop up in there.
Yeah, no, they're probably Soho House in their white sneakers, like Iman's wearing, with their dog
Shucks.
in their hand. But yeah, that's what I take away. And there was a gap in the market. We needed the product, and Sprout built it. So please.
Yeah, I feel like we've not wasted our time in terms of what we put out there. That was good. That was good. The one thing, and I'll come back to the story and the pitch in a sec, but
Please.
The one thing that you briefly touched on, I think is the most important part of that, is the quality. And it's not just about building a basket. It's also about kind of, if you take any given angel investor, right? Like you guys have been investing for a while now, deal flow is king.
Yes.
And you can be the best diligencer in the world. I'm not, but I'm above average. But if you just look at crap deals, you're going to do crap deals. And part of investing in the funds, rather than kind of being an angel and building a basket, is you can build a basket with 100 bad startups, or you can build a basket of 100 startups or 50 startups with kind of professional level deal flow, full-time DD. I just wanted to highlight that part of it, but I'll do the spiel now. So Sprout is the investment platform for private investors to access top-tier venture capital funds. We're all, as you said, we're a team of private markets professionals. I've got my background in working with and for private market funds, diligencing businesses. My co-founder, Dan, he started his career in assurance, then went into corporate finance, then spent 4 years in private equity. He's got a combination of kind of turnaround PE experience and direct investing, both early stage and growth stage. And Rich, as you said, was a co-founding member of PwC's Raise team, and he spent 7 years advising startups, coaching them through fundraising and introducing them to VC funds. He's got an unbelievable network in the industry. It started in kind of my late 20s, which is still not that long ago, where I had this experience of DDing businesses. I got an economics degree, worked in financial services or professional services for however long. You kind of have that financial awakening where you go, well, my pension's 100% in the stock market, my ISA's 100% in the stock market, I bought my flat, which I'm lucky enough to have done. So my current portfolio is like 99% public markets and real estate, which is, to be honest, like more diversified than most people, but it's not a very well diversified portfolio. And I'm like, well, I'm working for and with some of the best private market funds in the world. VC in particular as an asset class has outperformed every other major asset class in the last 20 years. Top quartile VC is even better than that. Why am I not investing in kind of, or capturing the upside of early stage investing? And you're right, like the first natural thing to do there is, well, okay, I'm going to go and invest in some startups. Like I'm trained in DD, give me a business, I can tell you to a reasonable degree if it's a good one or not, if there's an opportunity there. And I can't tell you who's going to win. I can have a pretty good idea who's not going to win. And so I started to do that with Dan, who's my best mate as well. He saw some deals, I saw some deals, but crowdfunding sites in general, it's kind of bad deals at questionable valuations. The only good ones on there are on their because you want advocates, etc., rather than other reasons. I'm sure exceptions apply. Please don't get angry at me. And they're also heavily B2C focused, because that's why you generally go for crowdfunding. And actually, when you look at it, most of the kind of biggest deals, best deals are B2B, or kind of not traditional kind of consumer brands.
Or they're hard to understand.
Or they're hard to understand. And you realise very quickly, even when you're looking around, when you're looking at deal flow, that I'm not seeing the best stuff here. And the best stuff I'm seeing later stage, and probably after like 1 million better connected people than me are passing on it. So you're only as good as your deal flow. And in the public markets, you can back a manager.
Yep.
Why would I not do the same thing in the private markets when you're going out there and you're going, the best VC funds are teams of 5, 10, up to 80 people. They are scouting full time. They are usually sector expertise or experts, or they have like regional expertise where they're seeing kind of the best ideas in a region. You're paying like 2% a year on what you commit to them in terms of kind of management fees. I'm never going to beat these guys. It's just not going to happen. I'm not going to be an average fund. I'm not going to get close to beating the best fund. So why don't I put my money in? And the first point to note is that at this point, I'm way down that kind of decision journey from most, right? Because at least I understand private markets. I've worked in them. I know loosely which funds are good. But even when you do know which funds are good, you realize that you need to know them to get in often, because they can choose who their LPs are. If you can raise 100 million from 5 people at 20 million a pop, why wouldn't you do that? Why would you go and take 100k off someone or 10k off someone?
Yeah.
And even if you are mates with them and they want you in, like the minimums for the best funds are normally at least £1 million. Sometimes it's 5 million plus. So like, thankfully I meet the sophisticated investor, high net worth investor thresholds, lovely, happy days. But they won't have me in their fund. So what's the point?
Yep.
We can't be the only people who have this problem. So we did a couple of things. So step one was so Dan and I were experienced in private markets. We needed someone who was deeply ingrained in VC. Dan says, I know a guy, introduced me to Rich, who had been working a floor apart from me for 6 years, and I'd never met him, probably because I'd been stuck at my desk for 6 years. We got friendly. He came on board. We were like, let's do a proof of concept. So we did. We placed 200k euros into a French VC in 48 hours via WhatsApp with friends. We were like, okay, there's appetite here. And then being a consultant, obviously ran a survey to test the appetite with a wider audience, and kind of venture capital came out top right in terms of most desirable, least accessible asset class. We were like, I think we're onto something.
Yep.
How do we turn this into a business that's actually scalable? Well, you want a platform where private investors can come on, curate a selection of the best funds. We've done the DD, we've done the filtering, and they just go, I want to invest in that one because this one does X and that one does Y. And that's essentially what Sprout is. We set out to raise a pre-seed round kind of back end of 2021, closed it Jan 22. I went full time, kind of gone from there. We've worked with 5 funds. We've looked at over 200 funds in the last year, and we've picked 5 to work with, to give you an idea of like, and we'll come on to this, how fussy we are about who we work with. And the idea is to now build we've got a community of engaged, motivated private investors ranging from, as you said, professionals, senior professionals, through to high net worths, ultra high net worths, and family offices. And the reason, we've evolved how we talk about this. We don't use the word democratization anymore, because I think it's quite hard to talk about giving access to family offices and also saying you're democratizing something. Right. And also the bottom end, like, we're not going to mass market retail, regulatory reasons, high net worth, sophisticated investor, kind of as low as you can go, but still over 1 million people in the UK. And when we talk about what we're doing, one of the funds we're working with at the moment, the minimum is normally 5 million. We made it 5,000. We're making this 1,000x more affordable. That's pretty good going. So that's where we are. We've got over 650 active accounts on the platform across all of those profiles. It's growing quickly. We are super excited about the direction we're traveling in. We're working with better and better funds. We are unlocking unbelievable co-investment opportunities, because one of the things we are saying is if you're really going to invest direct and you're not doing this full time, at least invest alongside really good funds that are doing the DD. And we're really excited about where we're going. And also quite tired, but that kind of comes with the territory.
What's your vision then, if you had to sum up your vision?
So we want to be the go-to place for private investors to invest in the private markets.
And what does your competition look like if you take that vision?
That's a good question. So right now, no one's doing what we're doing in terms of nobody is offering kind of top tier VC funds in the UK and not really in Europe. There are different models where people have gone, we're solving this part of the problem, that part. So there'll be people who have put together a fund of funds because at least you can offer a basket and you can spread the risk and you can offer liquidity. But if you do that, then you don't get the co-investment, which is one of the best parts. So we want to replicate that LP experience. The idea is that we get as many people as possible able to invest like the billionaires do. That's the idea. Your billionaires are not investing in fund of funds. They're investing as LPs into the best funds and they're co-investing where they want. I guess the best success case is a company called Moonfair, based out of Germany, ex-KKR guys. They have done something similar, mainly focused on PE, in fact, blue chip private equity. They've got something like 3 billion AUM in terms of euros, and very few people have heard of them.
Right.
So when you're talking about kind of the market opportunity, someone's come along, done this in private equity, sold to bankers, sold to people in PE, and honestly, their brand awareness is very, very low.
But is that brand awareness low for who? Like you mentioned that your target market is basically 1 million people, so they don't actually have to
in the UK.
Sorry, they don't have to spread their message too far or be too publicly.
Correct, but we are speaking to people who would, in theory, directly be in their target market.
Okay, fine.
I think the bigger point here is like they've done an amazing job. They've built a big business that's already big. It's been valued at a lot. They're now over in America doing it there. They are going for blue chip private equity. We're taking a slightly different view, which is bringing the best of private markets to the private investor. So starting with VC. Sorry, go on.
No, I was just going to say, so I hear all of that. My market observation is, and you can correct me if I'm wrong, is that the only real competition, I wouldn't call it competition, but very similar business model is Allocate in the US, which is Samir Kaji, been on the podcast.
Listen to the podcast.
Thank you. And you guys both have very similar business models. But I wouldn't view you as competition because businesses like whether it's Allocate or Angel List or whatever that allows flow of capital to startups or venture funds that's based in the US, they have struggled to operate in the UK for various issues. Angel List have pulled out of a lot of service. They offer some services still in the UK, but not the full suite because of like compliance or regulatory or whatever. And I looked into this and we have some contacts there we spoke to. So that's why then you had different players in the UK propping up different services. You have like Odin doing the syndicates and the SPVs, which is Angel List original products. And then you have you guys who are similar to Angel List venture funds product and also Allocates more so. So I guess you guys have the market expertise and boots on the ground, which the Americans don't and cannot really penetrate the UK market.
Look, I think Allocate are a good business. I actually think it's really interesting listening to Samir on the pod. Like the way we talk about the opportunity and the problems and how they need to be solved, it's so similar.
Yeah.
And I haven't listened to him speak a lot. I know he's got his podcast, but actually listening to the podcast last week or 2 weeks ago, I was just like, I've used a lot of these words in a similar order, which is a good thing, right? Like everyone's recognizing the problem. People have different ways of solving it. I think the other thing is just, the market opportunity in the US is so big.
Yes.
That will let people worry about America and we will solve the problem in the UK and Europe. And then we'll figure out like the greenfield opportunity here. I want it to all be us, but it can support a few people.
Sure.
And
sorry, just to come back on your numbers because I'm a consultant and I like to check your numbers. So you said there's let's say the total addressable market in terms of people in the UK is 1 million. What does that number look like in the US, and what does that number look like in Europe? And then
I'm not allowed to open my model.
You can open your model if you want, but ballpark. But also, is there a delta? Is there a difference in the quality of investor across these different markets?
Yeah. So if I take a step back in terms of how I answer that, because it's not the 1 million people in the UK is based on you're looking at income over 100k. So it's a slightly different market from how an Allocate would define it, because we're not just going after families, we're going after high net worth and sophisticated investors as well. There's a number of different ways you can cut the opportunity, right? You can cut it by wealth, you can cut it by income, and you can cut it by kind of the opportunity to kind of move wallet share across from other asset classes as well. When you look at it in terms of like addressable wealth, it's a stupidly big number. there's a UBS, I think it's UBS or Credit Suisse kind of global wealth survey. They publish data on the number of high net worth, ultra high net worth individuals, and a family office is slightly different, but you can basically look at it by the number of people in the UK or Europe, US, and global who have net worth over 100 million, over 10 million, etc.
Yep.
You can plug that in to essentially when you look at what a sophisticated family office does in terms of VC allocation of 10 to 15%, based on UBS survey and Silicon Valley Bank survey, and you go, well, actually, they're not going to do that in 1 year. They might do that over like an 8 to 10 year period. You start getting into kind of, if you look at wealth alone, what would the annual flow into VC should be based on current market size, etc. And you get numbers that are in the tens, if not hundreds of billions, and it just all looks really stupid. But the point being, it's huge when you look at wealth. Even when you look at income, and again, right, like you would be looking at wealth conceptually because you're looking at people who have parked savings over time and moving it. Even when you look at income, that opportunity in Europe is still kind of comfortably tens of billions a year alone. Granted, you're taking a base of 100k. The way we would do it, just for the consultant in your head, is you have got a number of people earning over a certain amount. You have the number of people that conceivably would like be looking at this asset class, right, which is kind of a lower percentage based on, here goes the consulting lesson for all people who haven't done it. The people earning 100k,
I'd fail him, by the way.
You put like 5 or 10% of people, it's all based on data. 5 or 10% of people earning over 100k, it's eligible for, but everyone over, making millions a year, it's all of them, average ticket size, etc. You play it through that. You still get tens of billions a year in the UK and Europe. So in terms of the actual size of it, however you cut it in whatever geography you look at, it's colossal. In terms of quality, when you say quality, do you mean size and profile?
No, I mean, well, partially, but I also mean this point which we touched on earlier around risk aversion. So you can create a model around who you think might be targeting venture as an LP, but actually in reality you might find that is a bigger number in the US, right? So you're targeting more people. For sure.
That ties in with the kind of other side of Sprout, right? And we talk about Sprout in terms of the product we're unlocking and the people we're connecting it to.
Yeah.
But there's a huge part in the middle, which is how. And the Sprout community is at the heart of what we're doing in terms of how we're building the business and how we're building a moat around what we're doing. We're building, everyone throws community around, right? It's an easy word to use. Our first hire was a head of community. Ellie joined us. She's ex-Founders Forum, ex-Young Foodies, brilliant. She's got a background in community, partnerships, events, what she does every day. There is a huge education and engagement piece to this. We are years behind the US in terms of VC as a market, in terms of understanding and sophistication. I've spoken to partners, without naming names, who work in private equity, who work in strategy consulting, who I've had to explain the model of a VC fund to. I've had to explain capital calls to them. And that's fine, because the numbers are strong and powerful. You're looking at people who are getting, when they're working with a wealth manager or a private bank, they're happy to get somewhere between like 4 and 12% a year, depending on their risk appetite. You're looking at kind of the average VC fund doing something like 13% annualized. Top quartile gets you into 25% plus net of fees.
Jesus.
This is exactly why we do mostly US syndicates and just,
So when you look at what people are getting versus what this asset class represents, the numbers alone carry a lot of weight. But you need to get people comfortable with the liquidity profile, the capital calls, the risk profile, which we can have a whole conversation, by the way, about whether the best funds are actually risky or if they're just high variance and are liquid, because in my opinion, it's the latter. But lots of these things. For me, that's an opportunity, right? Everyone's like, why has no one done this? There's reasons no one's done this. The structuring's really difficult. The go-to-market's really difficult. All the rest. But everyone who understands it is just like, why am I not doing this? And we are doing 2 newsletters a week. We've got a blog that goes out every week. We have in-person events of different profiles, right? So for our family offices, etc., they'll sit down for lunch one-on-one or in a small group with the fund. The other larger events for our community are 50, 60 people, drinks, come along, meet other investors, no hard sell. Tons of work, video content with the funds. Well, we're trained in DD. We're asking the questions of the fund. We're letting our community submit questions in advance. This is how you grill a fund. We're providing DD in the materials. We're showing you where to look. We're helping you understand what you're doing. And it takes time. But when you talk about quality, for me, it's not about quality. Because at the same time, I could say to you, if I go to America right now, every wealth manager, every private banker is expected to bring VC to their client. They might not do it, but the most discerning investors there are already doing VC in some way. So whilst I could start Sprout in America, I'm solving less of a problem. Now, access to the best funds is a problem, but access to VC in general is not, because, and I'm sure you will come onto this, there are a lot of VC funds out there.
Yeah.
We are educating and mobilizing thousands of people and doing it in a way that offers them a quality of investment product that no one is doing. Very few can do. And if we get this right, which I think we're doing, but time will tell, we will build a moat around Sprout as the authority in the private markets where people go to learn and invest. Because if you just deliver product, you will be disrupted.
I think so. Number one, I think you should lead with that in terms of your sales pitch, which I think you do, which is, I know you don't like the word democratization, but I genuinely believe there is a level of democratization here in how you're pitching it. The education aspect is probably, like you say, the least understood. It's like the least understood investment vehicle or area in basically all of investment. But equally, I have friends that are private bankers, particularly in this country, but in the US, that just don't even give a shit. And they don't give a shit because they think it's all like woo-woo fantasy. No one's going to pick a fund that's invested in Uber at the early stage or whatever. Like, they don't think in the ways, they don't think in a positive way. It's there's a negative element to investment in this country when it comes to early stage.
So I think the really weird thing for me is that both the regulators and, I'm going to say people because it could be bankers, it could be investors, don't differentiate between startup investing and fund investing.
That's a great point, yeah.
Which is the whole point of a fund is to mitigate the risk, build a portfolio. They run the maths, right? Like, depending on stage, yes, the chances of an individual startup failing is 90% or greater. Some of that is because when you speak to a lot of startups, you realize that a lot of them are terrible.
I want to ask you a few things I've written along the way. We can quickly touch on these. So people listening, they'd be like, cool story, bro, but why would I want to access a venture fund? So 101, someone doesn't really know much about it. Let's say we come from the banking or consulting world. You have people on 6-figure salaries. They invest in their little pension, whatever, their little S&P or MSCI World Index. Great, all is good. You've read Morgan Housel, Psychology of Money. You're doing all of that stuff. You're going to be the rich janitor. But you have a bit of money left over, maybe 10%, 5%, that you want to do either more speculative activities with, or you just want to try the whole venture startup thing with. And but they don't know. Why would they want to access a venture fund is the question.
I feel like before I go, I'm going to be told that I have to say this. Nothing I'm about to say constitutes investment advice.
Yes, this is actually, you don't need to say, it's plastered all over disclaimers and descriptions and end of every video. And but anyway, please.
Okay. So, look, as I said, venture capital is an asset class. So venture capital funds are the highest performing asset class for the last 20 years. If you invest in an individual startup, in particular early, and it goes big, you can make 1,000, if not like more, times your money. But the chances of doing that are astronomically small, and you're only going to do that if you get into the best deals. The chances of you, generic angel investor one, finding those deals are close to zero. So inherently, if you are an angel investor who's never done this before, there is so much adverse selection. You are going to be looking at deals that other people have passed on. And if you succeed, it's luck over process.
Right.
If you want to be angel investing over a long period of time, build your own deal flow, you need to be committing serious time to it, probably resource, and be prepared to lose money or just say no to loads of deals until you get there. But also, you only get to see the better stuff by doing deals in the first place. So it's a bit catch-22. Yeah. You guys have gone through this. You must be seeing much better deals than you were when you started.
Absolutely.
And still, like,
pounds.
Not the best deals, and not the one, you're not investing, well, you might be, but you're not investing alongside like top 10 VCs in Silicon Valley yet.
Well.
I said yet.
We've done a few, actually.
By the way, this was not a plug. This was not a segue to their ad for whatever.
We've done a few, but I won't. I get accused of pitching too much, even in my sleep. So
okay,
for the first time in my life,
for me to choose.
For the first time in my life, but rational.fund is the domain. You can check our track record, press releases, investing. Just alongside some tier one, some light work. But anyway, please continue.
Founders Fund, if
just
you
some
want to
light
invest
work.
alongside.
$500,000
I should have known you guys were already there. Point being, it's taken you years together.
Correct. Absolutely,
right?
Yes, it has, and we're just getting started.
And a lot of hustle.
Yes.
So what you have is you have professional venture capital funds. You have dedicated teams of analysts and investors with experience in a range of industries and prior careers. Cyrus, isn't that correct? A whole host of prior careers.
Yep.
Who raise a pot of money.
Yes.
And it is their life's work to go and find the best businesses around to invest in. Normally with what we at Sprout call a thesis, but you could call it a strategy, right. Where they have a thesis on why they are going to see deals no one else sees, see the best deals and win those deals. Because VC now is capital's commoditized. Mm-hmm. Even if you see the best deals, you might not get in. You have to, really fight for those. And actually, there's only a handful of deals a year that really move the needle for a lot of the best funds.
Sure.
So what we are saying is the best funds, historically, have done 25% plus annualized in terms of net returns. So that's after they've taken their fees. Mm-hmm. And instead of going out and trying to find the next Uber that, by the way, very lucky was founded by like your mate's cousin.
Yep.
Probably not. Go and give your money to professional fund managers who will charge you 2% a year, a little bit more via Sprout, between 0.65 and 0.9% a year, and let them go and do it. Because even with those fees, you probably won't come close to matching them. And it's that simple.
Amazing. Okay.
Does that answer your question?
Absolutely. Well, I put myself in the shoes of the...
Look that way.
I put myself in the shoes. I put myself in the shoes of the. I'm trying to pitch, but no, realistically, I put myself in the shoes of the layman or someone who just maybe tuning in has no idea. They're like, okay, I work in corporate. I'm on a good salary. I don't know what to do with this money. These guys are talking about these venture funds, but I hope that would have cleared it up. My other question, after this, I've wrapped up. We can continue with the other topics. Is this is an important thing for me? Is how long you've known someone, because relationships compound, as we said. How long have you known Dan?
I've known Dan for 10 or 11 years. We've got a lot of mutual friends. He lived with so he was at Notts Uni with basically everyone I went to school with.
Right.
Lived with a lot of my friends at uni. We got particularly friendly final year of university when we were going through kind of job applications, applying for similar things, wanting to do similar things. And so it's actually kind of started off as like a professional based friendship. Then we got friendly, ended up working in the same building, obviously saw each other, had lunch every day, and yeah, we're now best friends. So yeah.
Okay. You want to move on to the whole VC venture partners and
yeah. So let me recap in case it's been hard to follow, which I don't think it has. But basically you do partnerships with venture funds and only the best of the venture funds. So you're very particular, 5 of I think you said 400 or 200?
200, but if you want to say 400, I won't correct you.
400. So you're essentially partnering with these guys. But what you said was a lot of these funds can be kind of shit, and that's evidently the case if you are passing on 195 of 200. Why? Like, what is it that's shit about them? And please don't hold back.
Can I clarify that I didn't say that the 195 we passed on was shit. So within that, there will be some the timelines are too short, or we've already got another fund on the platform with a very similar strategy, so it's a bit confusing for people, or they're good, but they don't have a long enough track record. Let me flip it and give you an answer on about how we select the funds, and then
let me just pause you there. This is what a consultant does, by the way. He turns the question on its head. Very good. Continue.
So we've got a proprietary scoring system which we call the 10 T's, because I'm a consultant and we had to put a framework around it, right? So we score every fund we speak to based on thesis. So what do they invest in? What's their superpower? How do they source deals? How do they win deals? What is differentiated about them? And we'll come on to that, because I think a lot of people raise a fund, and they raise a fund because they want to raise a fund, not because they should raise a fund.
Oh,
not because
we talk about this all day, but please.
Or not because they've
we're getting into it now.
An area where they
Please.
can actually invest better than, what value are you adding to the ecosystem, right? So
Yep.
I think that's one point. Track record is probably the most important, or equally important, strategy. We look at track record in two ways. Number one, IRR. What's the annualized return on what you've invested to date? Number two, crucially, DPI. So distributed capital, distributions to paid in, that's a ratio.
You can't eat IRR.
You can't eat IRR, you can eat DPI. Cash back to investors matters. Why? There's a lot of funds sitting on very nice chunky paper returns right now.
Yep.
Doesn't guarantee anything, and can still move around up until the point. That is linked in track record is super important. And I know you've got a question on emerging managers coming up, and that's a lovely area to explore, and it's a really exciting area. But the data shows you that the funds, the best predictor of future top quartile performance is past top quartile performance. So whilst past performance doesn't guarantee future results, it is the best predictor. So one of the things we're looking for is funds that have consistently performed and returned cash to investors over a multi-fund cycle. Within that, we also want to see that funds are not being returned by one amazing investment. So we looked at a fund that had a 7x on a fund, really good. It was their first fund, it was $1 million fund. Fine. I said to Rich, I bet you they've done 10 100k tickets and one did a 70x. Guess what? 90% of their investments went to zero.
Yep.
So there's a level of DD under all of that. So thesis, track record, we then look at the team and their backgrounds, which I'm sure you have lots of questions on.
Yep.
Timeline, do we have enough time to actually do this properly, communicate it to our community, do the events we want, etc. Terms, is there anything weird going on there? Tag along, do we get co-investment that we can pass on to people, etc. You're testing me now.
I can pull it up for you if you need.
None of us can name the 10 off the top of our heads. There's the secret sauce. That's the one that's slightly dodgy. Every fund's got something where, the thing with the scoring system is you plug it in, you play it back, and there's always something that's quite hard to articulate.
Right.
It could be specific deals that kind of are landmark deals for them. It could be brands that are super well known and logos. It could be a specific way of sourcing opportunities that no one has. It could be a really strong brand. And the reason brand actually matters, I had a conversation with someone on another podcast,
It's all about the branding.
it is all about the branding. You did that before
We
the
did that
cameras
before
are
the
rolling.
podcast. It was exciting. Anyway, please.
But, in a world where capital becomes increasingly commoditized, actually, as we said, it's about your ability to win the deals, and therefore having a brand where founders want you as an investor matters hugely. Landscape VC are also doing great work in this space, right?
Yes,
in terms of helping founders rating rating funds so other founders can see who you want to take money from.
Yep.
That becomes a real differentiator in a space where £1 is equal to £1. Who do you take it from? So there's a whole range of those things we're looking at. So why do we not work with funds? Well, it could be that their thesis, right? It's not clear what they're going to do with your money. And I promise you, I've looked at funds where you read a deck and I'm just like, okay, what are you going to invest in? How are you going to find deals? How are you going to win those deals? How are you going to find deals that no one else sees? Or are you just going to see a lot of deals that have been passed on by better investors than you? Slight pivot into private equity. I've looked at the decks for some of the biggest private equity funds in the world. Don't tell you why they're good. They just tell you that they've made money before, and they're just like, give us money. And I'm just like...
A lot of that comes back to the brand element of those large PEs.
Some of it's brand, some of it's who they're selling to. They're selling to large institutions that are purely investing in... You don't get fired for hiring IBM, right? You don't get fired for investing in insert brand name of large private equity fund.
Yes.
So that's on thesis. On track record, there are first time funds are hard, and we'll come on to how we pick emerging managers as and when we do it. It might just be that you've had one really good fund and two that are okay. Well, we don't want that, because we want to see that your process works repeatedly. if you've had two funds that are doing a 10% net IRR and one that's done a 30, okay, explain to me why the 30 is the new normal and it's not the 10s we should be looking at. Paper returns we've talked about, right? There's a lot of funds that are talking about amazing numbers, but like 0 DPI. Only world where that's kind of more okay to get over is if they're super early stage, because the lag between investing and actually exit could be up to 14 years sometimes. It's getting longer and longer. So there's a whole range of things. And we want to be fussy because actually, whilst we're not advising, the quality of the funds we're working with is a reflection of us. And we're curating and standing behind the brands on our platform. And it also means going forward, when you set the bar really high, it's really easy to lower the bar. It's really hard to bring it back up. And the funds we're looking to work with now want to see who else is on the platform. So as soon as you pull that bar down, you potentially compromise the quality of who you're working with in the future.
So there's a couple of things I want to touch on. And I suspect this is worse in the UK, actually. But
the weather.
But Iman, I think you recall this, Iman, and we'll try and find this to put it up on the video editor of this podcast. Gary Tan shared the statistics or the data around venture returns in the US, if you recall. And most VC firms in the US, which is the Mecca, just about break even. Few get 2x returns, and very, very few get 3x plus returns. So beyond, and I suspect it's worse in the UK. With everything you've outlined, beyond those 10 points that you outlined, what do you base your decisions on? Like, how do you avoid biases like that we're all susceptible to as human beings? Because you've listed a bunch of them already. Survivorship bias. You've done this already. Yada yada. But is there any other method or way, or how do you avoid biases?
So I'll answer the first point because I think that comes back
Please.
to how we select, right? I think what you actually see is that, we talked about who's raising funds and who's investing. The reality is that, 2 years ago, if you guys probably could have raised a fund, and people probably would have given you
We had
money.
soft commitments in the 7-figure ranges, and we have a whole podcast linked here where we discussed our decision in the peak of the market to not take the money and go for syndicates.
Right. And
students of the game.
And when you look at the kind of numbers by volume, you've had a lot of people raising funds in the last few years, and deploying capital is easy, right? Like there's a lot of funds, without naming names, that
Name them.
No, that report and kind of talk about how much they've deployed. Well, I could go and deploy 100 billion tomorrow if I wanted to.
Yeah.
It's very hard to deploy well. It's very easy to deploy.
Massason is a great example of this.
Tiger.
I don't know. The jury's out on Tiger. But anyway, sorry, continue.
So when you look at the data, you have to remember that there's a lot of noise within the data. In the same way that when I said with startups that 90% fail, what percentage of good startups fail? What percentage of startups fail once you're like, oh, it's a good idea and it's backed by someone good? There's all these hurdles you have to clear. Same with VCs. When people treat them as homogenous, go and look at that data by stage. Go and look at that data by first, second, third, fourth time fund. Go and look at that data by prior returns, and you start cleaning it and cleaning it and cleaning it. And you can never guarantee performance, but you can start filtering that the best performers keep performing.
Yeah.
Because what happens is once you get it right, there's a whole load of things that kick in that make it easier to get it right. I mean, first of all, your process was more likely to have been good than not if you had a really good fund. Right, especially with exits and multiple successful deals. So you probably got something right in how you're investing. Once you've done that and you've got a specialism, you've got a niche, and you've got a reputation, you start winning better deals.
Yep.
You start winning better deals. A, you make more, and B, founders start choosing you. Then you start seeing better deals. So success begets success in VC. So there is survivorship bias because the bad funds drop out or should drop out, and there are some that don't. But it's also that, it's not rocket science in terms of good people who have always invested well should continue to do so unless something materially changes. And I think one of your questions, and I'll answer it now, was around what funds shouldn't do and what funds don't do. Is often where you see mistakes is where funds get a bit excited, right? And they might go into a sector they've never invested before. It's well, if all your success has been invested in businesses that look like this, and now you're going to go and invest in a sector you haven't worked in, you haven't invested in, how do you, and you might be able to do it, but how do you change your process or your team or whatever so that you can go and win in that sector? That's one. Number two is fund size, right? There is kind of a practical cap on fund size depending on stage that actually makes sense, right? Like if you're, especially again, it's different between US and UK, it depends between US and Europe, but like don't go and raise £1 billion seed fund in the UK. Because, well, unless you're prepared to follow through into kind of 2, 3, 4 subsequent rounds, what you're going to do, like 1,000 companies in your portfolio? So there are certain things around discipline, around strategy that are kind of quite important to kind of keep your eye on there. So that's one in terms of those returns. The second part to your question, the first one was on distribution. The second one was...
It was generally just around
UK versus US.
The biases, but
biases, of course. So when we started, inevitably the way we sourced funds, starting point was like who do we know?
Yeah.
Right. And you can still go through the same checklist. You can still go through the same like KPIs, the way you score them, but it was a bit more judgment based, and we wanted to take that out because I think at some point in October, Rich spoke to a really cool Tunisian fund, right? And I was like, I know everything they're saying makes sense, but I'm not putting something on the platform. But there wasn't too much of a debate. But like the point was, I'm not putting it on the platform just because we like it.
Yeah,
we need a kind of quantitative scoring system that overrides what we think, that overrides what we want, because if we get it wrong, and touch wood, we won't, I can't turn around to an investor and be like, well, I really liked it. And that's where the 10 T's came from. So we were kind of doing it anyway, but actually we built a scorecard. It's a weighted scorecard, right? On those 10 criteria where every fund is scored numerically on clarity of thesis, differentiation in sourcing, ability to win deals, IRR, DPI, strength of team, experience in team, terms, tag along rights, how long we have to promote it. All these things get you to a number. And that number is just a yes, no for the next stage of DD, but it's the best screen for like avoiding bias in the first place. Beyond that, when you know that everything's over a certain threshold, there is a bit more room for judgment because there's a business strategic conversation there around the mix of funds we want on the platform at one time. We always look for diversification across sector, stage, and geography. So I wouldn't want 2 UK B2B SaaS seed stage funds on at the same time, even if they're both great, because it's confusing. I wouldn't want, and I'm not joking, I've said I don't want General Atlantic and General Catalyst on at the same time because people get confused. Even if they're both amazing, you just got to have like a kind of human overlay to what you're doing because ultimately we're providing a product.
Very interesting. The question that will always get answered, and I'm sure you'll hear this a lot from people that invest in you, is how are you actually making money? So there are 2 ways to think about this. There's one way, which is if you think about a traditional fund, how do they make money? They make money through carry and they make money through management fees. You've already mentioned the fees that you have as a platform, which I think sound reasonable.
Very reasonable.
Very reasonable, I should say. Do you have access to the equity side of these things? Like, do you have any exposure to the potential for a 1,000x startup?
This is the question every Persian mum asks their son who does podcasting and syndicates and says, but are you making money? So the question is, how do you monetize? I'd also like to know.
So it depends on the product. The most basic Sprout product is investing into funds. I'll give you an example of a fund where the minimum is 5 million. If you want to invest in that fund below 5 million, we take a one-off 1.5% fee, and we take between 0.65 and 0.9% a year on top of the fund's management fees.
Right.
The way it comes out, it's you go in net, so actually the kind of total amount you pay in is actually less than if you just add our fees on top of the fund fees, which is quite nice. It's very simple. It barely moves investor returns versus net IRR if they'd invested directly. They get all the content, the DD, and everything we've talked about free, and you can invest below a minimum at a very small charge. Also gives us 10 years, 8 to 10 years of guaranteed ARR off the bat, which
for the fund life cycle.
For the life cycle of the fund, that sits in a ring-fenced bank account. We don't get it, but it's there. So from a business model perspective, it's great. It also gives security that if something did happen to Sprout and we weren't around, the vehicle still exists, it's fully paid for up front, and all investors are protected completely because we don't touch the money. That's the simplest model. We don't charge carry on that. We're not investing. It's not right for us. And I think the thing that runs true and through everything we're doing is we've built this for ourselves, right? Like, we're the customer. We're the people who experience this problem. Every single fee we charge, every single product decision we make, we've modeled out in terms of impact on investor returns. And it's all about making sure that we are giving our community the best possible experience and the best possible product. Obviously we need to make money in the middle, but we're delivering a hell of amount, that doesn't make any sense, hell of a lot of value for that. Co-investments charge differently. We charge between 3 and 5% one-off fee. If you invest in a fund, you get priority co-investment. If you invested in the fund and you get co-investment, you pay 3%. If there's any co-investment left, people who haven't invested in that fund see it and they pay 5%. So there's incentive to invest in funds to access co-investment and at a discount. That's co-investment. We are looking at unlocking more and more direct opportunities through co-investment, through some other networks we are now in, and through other funds who have asked us to invest alongside them. If we do that and we put together SPVs for that, that may be a world in which we take carry because we are arranging deals. But where we are just providing access to deals other people are putting together, it's not right for us to be charging carry on that. And I'm really mindful of charging where we add value and not charging for charging's sake.
Okay. Well, before we move on to the general VC market, which we can talk a lot about, I want to wrap up this Sprout segment with what the future holds for Sprout. So from my view here is that the plan is to become the vanguard for private markets in a sense, not exactly, but mostly, because as you said, for syndicates, etc., you may take some carry, which they may not necessarily do, but it's vanguard for private markets is what I'm seeing. Is that correct? And irrespective of that, what does the future hold? How will you expand? How do you think about all things growing, as you've seen, go-to-market, sales growth, etc.? Yeah,
so it's a really interesting one because it's a difficult question. I know where we want to get to in 5 years. It's really important that we don't try and do it all now. The single most important thing for me is to maintain, to build position as the authority in the space and to retain clarity of messaging with our community. And it's a natural expansion for us to offer other asset classes, right? It's a natural thing for us to offer other products. It's a natural thing for us to offer more funds. But when you look at who our audience is and when you look at the role, the hard work we're doing to build trust with them and authority with them and educate on VC, if you run too quickly, you pollute the messaging. If I've spent 6 months telling you all about venture capital and why it's the best performing asset class, and then I'm like, here's some mid-market private equity for you, that's fine for the right investor, but you've got to learn who to take it to and when, and you've got to know your community well enough to judge that. So in 2 years, we will be doing other asset classes. In 2 years, we will be in lots of other countries. In 2 years, we will be offering a lot more direct. And some of that will be in 6 months and some of that will be in 12 months. But it's really important, and we've got plans around it all, but it's really important to do it at the right speed so that we don't undo the good work we've done to date.
It's clear to say then one of your values is long-termism, which is one of ours.
It's really hard, right? Like the weird dichotomy of startup life is like trying to build something that's unbelievable in 5 to 10 years, but also executing now. But I don't want to blow up the 5 to 10 year vision for the sake of something now. And I think we get the balance right. But there's also an element of, I'm also very aware that some of the best and most successful businesses get there by pivoting. And at the same time, the way to win and succeed is to know what your vision is and kind of be unrelenting and focused on your vision. So just very mindful of getting the balance between knowing what we're working towards and being unrelenting in our vision and our mission, but also listening to the data and the signals enough so that we can like we don't miss the big thing. I'm very confident that what we're doing right now is the right thing, but I don't want to use the word stupid. I'm not naive enough to believe that nothing else will come along that moves us on that path. And we debate this stuff the whole time. I think it's really healthy to do it. So I can tell you what our our vision is, and I can tell you how I think we're going to get there. And I need the whole team to be pulling in that direction. But we also need to be kind of smart and agile enough that we like something else might pop up. And that's a really interesting, but like it's a really interesting but difficult like world to live in, where you're trying to do both at the same time.
Mm. Before we go and start talking about venture capital markets, should we take a wee break?
Please.
Like a small Scottish break.
Yes.
Okay.
A wee break.
Chicks. We're back from the wee break.
You'll get the volume better if you've got headphones. Never mind.
I know. It's anyway.
That's the whole point.
I didn't get a skin fade for nothing, my guy.
All right. Well, back from a wee break, we want to move on. We have, I think, about, let's call it 45 minutes, 40 minutes. There's a lot to still cover. We move on to the VC market, where we're both known to have a lot of opinions. I'll start with this before even saying anything. Why is VC harder than most people realize? Let's start with that one.
Ooh. Okay, so if you take, we've touched on it loosely, right? If you take any average startup, you've got a 90% plus chance of failure. So by definition, you need to be filtering like within the 10%. And to do that, it takes A, skill to know what you're looking at, and B, deal flow. So you could be the best at kind of diligencing businesses in the world, or kind of assessing businesses, try and not use the word diligence. But if you're seeing crap, you can only invest in crap.
Yep. Flip
side of that is you could have really good deal flow, but it will still kind of be a combination of good and bad. And if you don't know what you're looking at, you might not make the right decisions. People skew heavily towards their own experiences. People skew heavily towards B2C businesses over B2B versus like B2B. And also people don't understand the maths of VC investing. So risk profile, you're better off building a bigger portfolio rather than a smaller one. You probably need at least 20 startups in a portfolio. So, how many angels have that? Not a lot. Take the average check you write and times it by 20, 30, 40, 50, 100 and see if you can afford to do that many checks. If not, shrink your checks, do more deals. Good ones though. And there's also other parts of the maths that people don't really factor in. So you've got things like you've got the power law. So in terms of like the returns profile you actually need to make a portfolio make sense, typically the phrase is 80% of returns come from 20% of investments. It's often actually more aggressive than that.
Yep.
So it's not just like, is this a good business? It's like, can this business return all my investments combined or more? And people often don't think like that. So even when they get a winner and do like a 2 or 3x, they're still losing on everything else and they think they've done well. And also other kind of technical aspects of VC that you learn when you talk with funds. So things like the value of following on. And most angels don't follow on because they're like, I put my money in, that's it. And VC fund returns are maximized when you kind of double down and go in again to the winners. It's not all about the initial multiple. It's about kind of absolute returns on the total amount deployed. And therefore there are a whole load of technical things on top of making the right decision in the first place that are how funds maximize their returns. So go through all of that, and then it's like, and to do this, you need the time, the access, the contacts, the network, probably across countries, and or technical skill sets that differentiate you as an investor from someone else. Yep. And then after all of that, if you can then identify the best businesses, you still need to be able to invest in them. And therefore you need to know a lead investor well, or a founder well, or something, typically, to get into the oversubscribed rounds. So good luck, angels.
Okay. Now, my view, which Iman is hears this every day, but I'm sure knowing you for 25, 26 years, you also agree with this. But my view I have to give that disclaimer because several times he occasionally disagrees with something I say, and he has to.
I'm not involved.
But my view is that.
Can I just say before you say this?
Please.
You probably don't know this. I occasionally send Iman screenshots of your tweets.
Amazing.
Everyone does.
Being like,
who doesn't?
Where did this come from?
Yeah.
So anyway, far away.
I take that as a compliment. So my view is that most VCs are glorified middlemen. They are charlatans. They are glorified middlemen living off management fees, especially in Europe. Put that UK in that bucket, where they rarely have operating experience. Now, they don't have to have operating experience. Great investors like Bill Gurley in the US do not have operating experience. But I'd say he's an exception to the rule. I think the way the market is moving, you need some, not every partner at the firm needs to have, not every GP needs to have operating experience. But it would be nice to have some GPs, part of the firm, just at least one or two who have operating and or technical experience. Because when you're doing things like technical due diligence, or if you're a deep tech investor, you have a hardcore STEM background, you've spent years in the trenches, you may have been a VP or GM at SpaceX, whatever your field is or your expertise. And that's one issue I have. And I think the way the market is moving, when we started Rational, we'd always pull up whiteboards and draw up plans where we think the market's going, all of this nerd stuff. And we kept saying in 30 years, the best investors will be those who have had operating and or technical experience. Or now maybe you have some channel to distribute via a podcast or to promote your portfolio companies. But to me, that's still not good enough, which is why we care about doing this on the side and not as the main thing like some podcasters. Shots fired. Now, Taleb calls VCs rent seekers. We'll throw out one of my favorite tweets. Taleb said, venture capitalists had the reputation of ill-dressed people who helped progress. They will go down in history as ill-dressed, rent-seeking oligarchic vampires who play the gullible public by injecting neomania but are not savvy enough to escape detection. Now, some could say that's way too aggressive. A lot of VCs have blocked Taleb. He's blocked a lot of them. I think a lot of what we saw in the last 2-3 years was BS. What's your view with everything? Because again, like we had soft commitments to launch a fund. We've discussed this on a whole episode. We were so, not to plug the brand, but we were so rational enough to say, let's do the syndicate thing for a few years, get operating experience, continue compounding a bunch of other things. Because what I see in the US, and this is the last bit of my whole rant, in my first essay on rationalvc.com, the first essay I ever wrote, the / articles, the first ever essay I wrote, which kickstarted this whole thing, was tech markets are irrational. And in this, I talk about you have GPs at tier one firms like Sequoia, A16Z, Founders Fund, yada, yada, wherever. They leave to go and set up their own VC funds. And the first fund they raise, huge success in terms of the ease of the raise, because they have a lot of the brand cash, they have a lot of the clout, the social proof, and they bring a lot of the deal flow over with them to their own firm. So they have huge success. But then the problem is they're kind of forced to deploy all of this in 18 to 24 months, typical cycle of LP pressure to deploy, and then you have to go out and fundraise again. And then fund 2 and fund 3, you slowly see that they're starting to struggle to raise, and the payback period in venture is like 10 years. So they haven't really seen much returns, whereas, okay, fine, A16Z saw some big returns in the early years, but these guys are not A16Z, and then everyone begins to wake up, oh yeah, these guys are just another venture firm, even though the fund 1 was a big thing. So, and then it goes back to the whole thing I said earlier, why most funds don't even, like, they barely even break even, so let alone double the money. What's your whole take on? That's my take. It's a lot.
That was your one take and one opinion, and you would like my answer to your one question.
Yeah. I would love your answer, because as someone, you're in the trenches with these VC firms, and the last thing I'll add to this is I have been impressed, however, with the quality of firms that Sprout has picked, because you don't have many partners yet, and I know that that's a conscious decision, because again, you don't want to work with any Tom, Dick, and Harry. But how do you? Firstly, what's your view on everything I've just said? And secondly, irrespective of all that, how do you how do you tackle that? How do you see through? We've already discussed like your biases, your 10Ts, etc. But beyond all of this, my take is like, how do you see through all the bullshit? How do you? What's your take on everything I've said?
So, starting with the first part of what you said in terms of skill set and background, venture capital funds or venture capital firms are ultimately companies, right? They're teams of people assembled to do a thing.
Mm-hmm.
That means, like, what makes a good investor, what makes a good fund, and what would differentiate them from an angel, right? So we talked about the things they do in terms of sourcing and execution. You need to source good deals. You need to pick good deals. And ideally, you need to add value in some capacity to the companies you invest in, although that's not, it doesn't have to happen, but ideally it does.
But how could that be? For example, distribution, if you have a podcast or blog, you could promote the portfolio company.
Yeah.
Or if you have operating or technical
It could
experience,
be operating or technical experience, it could be support, it could be consulting, it could be a whole range of things. But this is where, so when I look at kind of a fund,
Mm-hmm.
you're not looking for, like you said, right? You're not looking for the backgrounds of individuals. You're looking for the collection of skills that give that fund the magic that allows them to execute.
Yes, 100%.
So would I assemble a VC fund of 100% investment bankers? No. But at the same time, would I recommend assembling a fund of 100% like exited founders? Also probably not.
No, definitely
Because
not.
we're all very aware that, as we just said, private equity works differently, but like you've got an entire industry focused on the technical skill of like vetting businesses, right? Deal sourcing is relationships, it's technical expertise, it's reputation, it's brand, it's like boots on the ground. Deal execution is technical, it's hard work, it's commercial, it's financial, and it's technical DD, right? They're all different skill sets. On a larger deal like a PE transaction, you've got 3 separate teams of between like 4 and 10 people doing each of those. Mm-hmm. There's no way one person in a VC fund can do those all to a high standard. So you do want DD specialists, you do want probably founders or someone technical in some capacity who can help with the DD. And then in terms of value add, what do you want? You want a deep network. You want a I don't want to use a platform word, but platform, right? Which is how a lot of funds try and differentiate themselves. You want door openers. You want counseling. You want technical support. You want consulting. So when you talk about backgrounds, like I'm with you, but it's also like you don't look at the individuals. Look at the way that fund, that team is assembled. One of the challenges you have is that a lot of the funds are just inherently small and they might have like 5 employees, and therefore you might have a big skills gap. Mm-hmm. As the funds get larger, there start to be fewer and fewer excuses for having the skills gap. If you've got a large 80-person team, you better have everything covered. If you've got a team of 4 or 5, you might have a weakness. But you'll also see that those funds won't have a full-time fundraiser, and then when we go and work with them, whichever partner's drawn the short straws in charge of IR for that raise. So inherently, you forget that a lot of the funds, or we forget, a lot of the funds are kind of small businesses in themselves. They might raise a large pot of capital, but actually there's not that many people there. So for me, it's about building the complementary set of skills that allow execution, like optimized execution in whatever you do, which is also where that kind of links back to strategy and focus. Like, do what you're good at, execute well on it. Don't try and do a million different things unless you've got the team, the resources, the capabilities to do that. So that's on the first point. I think that like it's fine that there's a lot of bankers and consultants in VC, but they need to know where their gaps are. In the same way that like it's good there's a lot of exited founders in there, but to be honest, like I know a lot of exited founders. I know a lot of founders. I wouldn't trust them to DD a business. I think they'd be really useful, helping a business. I think they'd be really useful at certain technical things, but everyone's got gaps.
And that's exactly my beef. There's too many firms with just one type of person times 10, and that's it. But
that's bad in any industry, right?
Yeah. Yes, but we've seen more and more of that over the last couple of years in the boom of the market and all the hype we've saw. Mm-hmm. So, but I guess this correction may weed out a lot of them and just kick them to the curb, and then now they have no fund and they have no real world skills either, or operating experience or technical experience. So
yeah,
they'll figure it out, the harsh reality of life.
And that comes on to the second part of your eloquently put speech, which was about kind of the mix of funds out there and the way the market's kind of shaken out in the last few years. And what we're seeing is just a real flight to quality.
Sure.
and I think it's quite a healthy thing, right? We're seeing it at every level. We're seeing it at funds investing in startups suddenly going, oh, there's this thing called revenue and there's this thing called profit underneath that actually matters at some point in the future. We should probably look at that. And there's asset allocators and LPs going, maybe we should invest in people who have done it before and not people who, you know, have a deck with a lot of pictures and talk a really good game. And I think those two things are related. There's been a healthy correction. I think that we'll see, you know, more money. There'll still be more money going into VC because VC as an asset class makes sense, right? Like, regardless of what happens at the macro level, I think it's really dangerous and kind of unhelpful to talk about it as a homogenous asset class, because within startups, you've got good and bad. Within funds, you've got good and bad. You've got experience and inexperience. And it's about filtering through that. I think that's great for us because what we try and provide to the market is that view of the world, is that let's cut through the noise for you. Let's help you figure out what you're looking at. We'll do that. We'll go and be like, we're not touching this fund because of X, Y, Z. We're not working with them. Oh, we like these guys, but we're not going to work with them right now. And I think it's natural that in a world where you know, interest rates have been low, the bond market didn't really exist for the last few years. There's been stimulus packages, so loads of money going to the public markets, interest rates low. IPOs are great. There's more and more money going to startups. It's like it's been inevitable, and you come back to paper returns versus realized returns.
Yep.
Like everyone's seeing friends making money. Everyone thinks they've got an amazing startup portfolio. Sad reality is a lot of angels are going to realize the things they've marked up loads aren't going to come true.
Yep.
The rising tide lifting all ships thing has come true, and like a lot of people got on and got off whilst the tide was going up. And a lot of people, we talked about property earlier, right? A lot of people thought they were genius property developers in the 90s in London. A lot of people thought they were amazing investors, and like that's just how the world works.
Yep.
And at some point, it stops working like that. And I think that's what we're seeing now. But when you cut through the noise, when you look at the very top of the market, not a lot has changed.
Yeah.
The best funds are still there. When you go and look at Silicon Valley, the best funds are decades old. They're on fund like 18, 19, and they're all, you know, still going really well and still seeing the best. And everyone else is fighting over the scraps, right? Not the scraps, but the rest. Like the very best businesses go right to the top and they get invested, and like a lot of them will still fail. But that's the game. That's the maths. That's the calculation. It's similar over here, and I think what we're just seeing is the same thing happening in a slightly less mature market where there's a bit more noise. You've also got other things creeping into early stage here. So, for example, tax relief, right, has played a big role. EIS, amazing scheme. SEIS, amazing scheme. Great for private investors and angels, and great for companies and good for employment, right? Like ultimately, it's just a giant wealth transfer of wealthy people who want to save some tax going and funding jobs in startups, and some of them have gone well, some of them haven't, and you know, you save some tax and you get some money back. There's a lot of people who candidly were not qualified or experienced enough to raise a fund, who have raised funds and deployed capital, in particular kind of pushing tax relief rather than pushing returns. Now, tax relief is lovely, but it shouldn't come at the expense of returns. And I think, you know, we've seen accountants who are like, I don't know what, like I've got clients who trust me, I'm going to raise an EIS fund. It's like, okay. And they raise one. And I just think what we're going to see is a lot of shakeout in the market. So I think when you go venture capitalists are X and venture capitalists are Y, it's like, well, they're not all the same. There are really good, smart people working really hard to build deep relationships, deep sector expertise, and put capital to work in really smart ways. And there are people who have really honest intentions, but are just not as good at it. And then there are people who have been opportunists.
Yeah.
And kind of there will be people within 2 and 3 who do well and others who fall away. And that's like, just like any market where there's been kind of boom years, we will see the same in VC. And I think what we're trying to do is just say, cut all the noise out. We'll come on to emerging managers where it's really hard to pick, right? Cut all the noise out. If you're going to take risk in the right way with early stage. Fund investing should not be the risky part of all of this. because it's high variance, it's illiquid, but like you said, the funds that are losing all their money are not. When was the last major VC fund you heard that kind of complete write-off on a fund or lost 50% value? Like a bad return for those funds is like matching the stock market.
Yeah.
That's disastrous. So you gotta, yes, take a step back and look at what's happening in the macro environment and what's been happening in the world over the last few years. But actually, when you want to look at all the critiques are valid, but they're valid of a subset of the market. They're valid of a subset of funds. They're valid of a subset of people who represent human behavior that we see in every asset class, in every era, in every economic cycle. It's just happened that we've seen a lot of that within VC in the last few years, and there's now quite a healthy correction.
I don't actually think. I think it's a good it has been a good portion of the market, but that was because of the good times, as you said. But this whole spiel was actually not intentional for me to give you the opportunity to pitch Sprout, but you have rightfully actually explained the issues and addressed. You've acknowledged my concerns. It seems like you agree with most of it, but what you've also explained is how Sprout's quality of DD and several other factors, things you bring into consideration, actually avoiding picking such funds and working with firms that, like as we like to say, thinking in decades and not months. Mm-hmm. So yeah, great. We've put that one to bed.
You touched on this, both of you did, in terms of the good times. Basically low interest rate phenomena, and part of that has explained why so many solo emerging GPs have entered the market, and why there is a lot of people calling them themselves venture capitalists when they're just chatting shit, basically. But the thing I want to ask you is, what do you think the honest, like, what do you genuinely believe the future of venture looks like in the context of rising interest rates? And in the context of these new opportunities around solo GPs?
I think, so in terms of how people are raising and how people are branding, ultimately, people who want to invest, like, we talked about branding, we talked about finding your superpower, we talked about, like, how are you going to win? People are finding ways to raise and invest and basically brand around that, right? So like if I wanted to raise a fund tomorrow, I'm probably going to do it as a solo GP because I don't have the capital behind me to go and build a fund. I don't have the track record behind me to go and build a fund, etc., etc. So I'm gonna create a brand. I'm gonna do content. I'm gonna XYZ. I'm gonna go out and invest, and that's fine, right? And like I might even do it as an EIS fund, maybe not, because then I can get some people to put some money in me. Now, if I was doing it with my own money, there are reasons why you don't do that, because it rules out sectors, it rules out geographic allocation and all the rest. But I would go out solo, I would try and build a brand, I would try and be doing content, and I would trying to position myself in the market so that actually my second or third fund, I can go out and raise a proper LPGP fund. In general, what you see is these are all ways for wannabe is not the right word, right? Aspiring fund managers to get their first steps into the world of VC.
Yeah, I agree.
Everyone's goal is to run an LPGP fund.
Is it?
All these managers.
Not for us.
It's an interesting point.
When I make generalizations, I'm going to like rule you guys out from being the exception, because we've had this with like a whole range of things.
Just before you continue, sorry, just to cut in. The interesting thing is actually you're seeing a lot of people take on that, really push for that freedom element that comes with not having to have a GPLP fund, and you doing basically what the Jason Calacanis model is, which is running out and setting up your own angel list fund and not having to worry about.
So, to an extent, and you see it with super angels as well.
Yep. But
it's normally where like they've got other things going on.
Yeah. Okay. Fine.
Like if you want to be a fund manager, go and be a fund manager. And if you can't, there are ways in, like a solo fund or a tax efficient fund or whatever. If you are a successful angel who's well connected, who has other things on the go, who's also a founder, right? There's a handful of super angels in the UK. Alex, who we talked about earlier, Alex McDonald's a really good example, right? Like he's got he's an exited founder. He's got a new business. He's running that. He also has unbelievable deal flow, so he syndicates into the best deals. Great. But that's not his ambition is not, as far as I'm aware, to go and raise an LPGP fund. That's where like being a super angel and putting together syndicates works, right? With you guys, when you build your big kind of rational VC media empire and you start syndicating into funds or whatever you guys aspire to do, it's because like the funds are almost the byproduct of the work you're doing, the relationships you're building, and all the rest. You are not defining yourself as a fund manager, and obviously you're then therefore not tied into a fund cycle. You're not tied in for an 10 to 14 year cycle, etc., etc.
Each to their own, but I mean, like exactly as you said, we optimize for autonomy, fun, and more freedom. So,
but I think the market only has room for so many super angels.
Yes,
I think it only has room for so many kind of celebrity investors.
Yes,
and I think that like the reality is that the successful investors of the future are still largely going to be the best LPGP funds. It's just they might get there a different way from how they have before. So what we've really seen is just like people, it's a market everyone wants to get into, and therefore you've had to try harder and harder and shout louder and differently to be heard and to see the best deals and win the best deals. And that's why we've seen a range of different models. But ultimately, the ones who want to be fund managers will end up in the same place. I guess the only overlay to that is this kind of hybrid media investy thing that lots of people have going, where I think ultimately that just becomes a differentiator, because like there will be more and more kind of well-known VC media brands who can add value. They'll bring you on a podcast, they'll shout your product out, etc., whatever they do to add value.
Via Sprout.com.
But that will just become another differentiator in a world where the capital's commoditized.
Yeah.
So ultimately what that becomes is you want us on your cap table rather than like media for equity or anything like that.
So we did a podcast episode a while ago about the difference between Andreessen Horowitz and Sequoia. And we looked at the time, Andreessen had just come out and suggested that they were going to set up a consulting and I don't know, like financial and legal
whole media arm, a legal arm.
So how do you actually add value to the startups that are in your cap table versus Sequoia, which kind of stuck to its original model, but then I think it shifted over time a little bit as well. But they've understood the value that comes from these sort of solo GPs and like private raisers, super angels as you call them, and said, how do we integrate that into our business? Yet the way they've done it is they've very much just become professional services, like investors with a professional services arm. So it is interesting how different players are playing it in the market, but I do like fundamentally I agree with you on what it is you're saying.
I think you have to factor in stage as well quite a lot, and I say this as, you know, an early stage founder. There's 5 of us, right? Our advisors, our investors can add a lot of value by opening the right doors and making the right connections. Like, is there value in marketing support? Yes. Is there value in PR? Yes. Is there value in tech? Yes. Is there value in a free website? Yes. Is there value in consulting? No, I don't have time for it, right? If you're, 200 people, 10 million ARR, whatever, you've got a team that can go and sit with consultants. You've got an in-house strategy team, or you've got a corp dev team, right? There's value in outsourced M&A. So the Sequoias, the A16Zs of the world, like as you raise bigger and bigger funds, as you go later, like, it becomes more homogenous. In fact, homogenous isn't the right word. The range of services you can offer just broadens, like right through to, it wouldn't surprise me. I mean, if look at an adjacent world where if you look at what's happened with kind of large cap private equity, where they've become like just capital providers, right? They're all doing debt now, and they're lending to each other on each other's deals because they're doing it better than the banks, and they're more agile, and they might go earlier and they might go later. What's the next stage? Was someone going to start buy a corporate finance house, right? So you get the CF fee when you IPO your own business. Like, I don't know, but there's the world of opportunity is obviously much broader, and the value you can add is much larger in a large business. At the same time, when you go earlier, there are actually quite small things you can do that are super helpful. So if you can add that, marketing and kind of basic support where you're taking out kind of a meaningful cost or a meaningful time drain. Legal support's another one. So I think it's going to vary. I also think you have to tailor the support to what the founders want. Because you can build, like, as a fund, you can build a huge in-house function that's a lot of money going out every month, every year, and like 50% of your founders might not want it. Where does that money come from? It comes from management fees. It comes from, you know, there's opportunity cost in that. So I get it. I also think that, you know, just with my kind of founder and CEO hat on, like, my time's at a premium. So like, for me, the things that add value are things that save me time rather than things that, like, could be super valuable in the long run, but I don't have time to actually put the time in right now.
Okay. And I suspect that will differ in different stages of the business, of
Absolutely.
course. But yeah. So before we wrap up and get to kind of a section a little bit more about you and do this whole full circle thing, the last thing I want to touch on is everything you discussed. You did mention content in the middle of all of that, and the importance of content in building any business nowadays. You are actually, I think you may have been anonymous, but eventually you came out as the man behind the account on Twitter, Gunner Punner, which is an Arsenal fan account. It's actually known
not after Wednesday.
We'll put that aside.
Rightly so.
We'll put that aside. I'm actually not even really into football much myself, but even I, many years ago, probably, who knows, 6, 7, 8 years ago, even maybe 9 years ago, who knows how long ago, but several years ago, would come across your account. It would just be somehow retweeted on my timeline, just whatever. And it was known to be, this is my view, to me actually, it was kind of like, you could call it the Taleb of football. It's very skin in the game, minus the anonymous part, but eventually you came out as the face behind it, so skin in the game. But you're very opinionated and just, you know, saying whatever the hell you wanted. So I rate that. But aside from that, how did you, I think you growing that account to a very respected account is super useful for the content game and what you're doing now at Sprout. How did you grow Gunner Punner and just the overall spiel around this whole social media thing and content game? Because you mentioned content, you know the importance of it. I know you're great at executing on it. What has this whole social media thing taught you, and what opportunities has it afforded you, if any?
Yeah, so I got into Twitter, like, I guess early-ish, like, I think 2010, 2011, 2009, 10, something like that. Actually, because I'll tell this. Yeah, I like shit jokes, okay. And I actually. Like,
so we'll get along then.
Yeah, really well. And first of all, I found like all the England cricket players were on it. So like the first thing I knew about it was like they were all chatting to each other, and I used to just go on the website before I had an account, I'd go on the website and see what they were saying, because it was quite like back when it was like Graham Swan and Stuart Broad and that lot. And then I realised like there was other stuff going on there, so I created like an account. It was like at Pun Times. And go and look at my first tweet. It was like, I can tell you what it is. I'm getting involved in rehabilitation for reformed vegetables. It's hard keeping them on the straight and narrow. Over time, I realised like there was actually like communities on there, and like one of the big ones was obviously football. So I at the time like kept pun in the name and Gunner, Punner, and it stuck. And because it grew, you just can't change it because that's what you get known as. And I found like a community of like really engaged, really motivated, and we talk about community and importance of community, right? Twitter's weird in that like it's lots of communities. Like yes, exactly. Everyone's Twitter is different. So when people are like, my Twitter's full of this, my Twitter's full of that, like one of the things I found is like it's this world where you can really lean into hobbies. So I'm in football Twitter, I'm in politics Twitter, I'm now in VC Twitter with my different accounts, but like if you want to learn more about something, go and find the best Twitter accounts in that space and just follow them and interact with them, and you'll just learn, and it's amazing for that. So I've built some unbelievable relationships through that. It grew a lot at uni because I had so much free time. I tweeted a lot, and actually like the big thing that drove the growth was interacting with people just naturally drives followers. It wasn't actually like any viral. I did make BuzzFeed's top 100 tweets of the decade, but we'll come back to that. But it was actually like less the viral stuff and more the like just building good real relationships with people who like over time I've met some really interesting people like from across the world, opened up opportunities, like met people, played at the Emirates, played at the stadium, like phenomenal, met sponsors, people who are coming back now, like Sprouts going on, and we're having business chats because like there's real people. Like sport's a great leveler. You don't know who you're speaking to online, which is good and bad. It's obviously full of, like, the reason I was anonymous is because like football Twitter's full of some of the biggest idiots you'll ever meet in your life. And I was just like, I work for a big company and I don't want like random 14-year-olds who like support Spurs calling up my employer and being like, oh, he's just said Harry Kane has like cheese for ankles. Fire him. Like, go away. So built up this. I think through that, I got into podcasting as well. You know, we talked about kind of the impact of work, you know, having the other businesses I've had, working at summer camp. I'm very used to being on a microphone. I've hosted, like co-hosted some of the largest Arsenal podcasts over the years. Like, you know, people I worked with followed me. So like people I worked with always knew about this, but it was this thing, it was this other world. And I think the other part of that is because it wasn't a real world and because it was anonymous, like we've all got these things in our life, like hobbies are good for a lot of things. And we've all got these parts of our lives where I am so disciplined and organized and like serious at work. And I think I've gone through this like journey where when I started my career, I was like me and I was like very unserious and I had to learn how to be serious in a professional setting. And then I was like that. And then I was like, I've proven I'm good. And now I can let my personality come back through in my job. And I kind of went on that kind of journey with it a bit. And my personality comes out a lot more now. But sometimes, and I don't know if you can see it on this, I switch back to like, I'm giving a serious answer now. And then I'm me again. And I think Twitter was this world where I could just be an idiot. Like I could say stuff. I never said anything terrible, but I could say like, I could overreact to stuff. I could like be in like undisciplined. I could say stupid shit. I could wind people up. Never malicious, never bad, but just like, you know, we draw 0-0 and it's like fire the manager. And it's just like saying stupid stuff that you would never say. Like, it doesn't matter, right? And it's been like that place for me to just be a child, but also, you know, increasingly over time, like my personality on there has changed, right? Like when I was a student, I was very immature and very childish. And over time, as you do more, as like I worked in football professionally a bit, I'm like, you know, actually like the voice I want now is more professional and it's more insight into how football clubs operate. And now it's, you know, it's a bit different again. And actually now, what is it? It's like, I'm quite good on football finances and how the business of sport and all that side. I also like getting really angry on there when we play badly because I don't have anywhere else to vent, right? Like I'll say rude words about Rob Holding when he charges 30 yards and completely misses the ball.
And gives a wink when he scores the consolation
and
goal.
literally plays terribly for 90 minutes and celebrates a meaningless goal, right? Like, and that's what that's there for. I think what that's given me is an understanding of community, an understanding of content, an understanding of kind of the role these things play and the power of a kind of strong online presence. I have friends who are YouTubers as well. I have friends who are Instagram. Like I through Twitter, I played in you know, hashtag United. I don't know if you're familiar with them. They've got like a 7-a-side league. I played in that on our team with some YouTubers, get close to them, learn about how they create content. And again, you just acquire things. And what this meant was like, I was doing like my day job, I was working in M&A, doing consulting, right?
Yep.
On the side, I'm a big football fan. I play sport. I have my Twitter. I do my podcast and my content. And I'm investing in early stage stuff as well, and my angel stuff. Not badly, fine. We'll come back to that. And what that meant was like a deal like Gymshark comes along in 2020. And out of everyone in my team, we're also weirdly, right, in this niche where we're long enough along in our careers to be experienced and kind of senior. And we're also young enough to understand tech, digital stuff, like branding, online trends and all the rest.
The branding.
We're in a really nice niche in our generation. And so like the Gymshark deal comes along and there's no one else in the team or the company, a welcome challenge from anyone else who works on the deal, who can sit there and hold their own in terms of like how the deal works, how we articulate and position a company like Gymshark, right? Especially to 50-something-year-old kind of investors in an audience, how you articulate that this brand has come from nowhere, their product, you know, they're like, oh, do we test the product to see if it's like more durable or like better performance? It's like, it's not the product, it's the brand, right? And how do we explain the brand? Well, let me explain influencer marketing to you. Let me explain that these guys got into influencer marketing before anyone else. Let me show you the power of their community. Let me run analysis. I go, I think this is going to work. We're going to do it. Let's look at the follower count of someone like Ryan Garcia over time. Not going to ask you this. I'm just going to draw a dot on the line when it starts going like that. Now tell me the month that he signed with Gymshark.
Yeah.
And you can see the impact of the community on that. So through early stage investing, I can then talk about market trends because I'm invested in some consumer businesses, and I can be like, this brand's doing this brand's doing this. So I've added value through like the social media stuff I've done, because I'm much more like au fait with all the social side of it. I'm very like active on Instagram. I followed a load of the Gymshark like influencers and athletes anyway. Athletes, not influencers. And I can also be like, here's the analysis you guys need to do that no one else would think of. We used to have a thing called digital diligence, which you may or may not have come across, which was a scorecard where we scored brands, like e-com brands, on how good their website was in terms of like number of clicks to basket, all things like that. On that deal, I invented social diligence. It was the first time our company had scored different D2C brands based on their social profiles in terms of how well they run each channel, how well they tailor their voice based on their channel, and a whole range of other things, how they adapt formats across channels. Could I have done that without any of my Twitter stuff? No. Could I have done that without early stage investing and talked about? No. And, you know, we talked about the opportunity cost of not doing stuff outside of work. Like,
it's exactly what I wanted to touch on. That's the key point that I guess listeners should not miss out on, is what we said earlier about you are doing all of this shit in the evenings outside of work, utilizing, take a shot, Naval, specific knowledge or just anything that felt like play to you and not work, your niche interests, combining them all and just doing whatever felt natural. But you were doing things outside of work, which is the key point.
Yeah.
And a lot of parallels, actually, because when I was at SVB, Huel came along and My Protein came along as companies to work with, and they immediately gave them to me because they knew I was like a gym junkie, and just, you know, that's what happens.
You sat next to this guy flexing like whole way through a podcast.
That's what happens when you're 7 years
You ain't
corporate.
seen shit yet.
We'll throw up a screenshot here of my now strength physique. I'm much stronger with less aesthetics.
Okay.
Powerlifting. He's more like the Iranian, let's just flex.
You know, like the guy, do you see Anatoly on
Anatoly,
on TikTok?
I don't know.
The
He's a professional powerlifter.
He's
who
like
goes
the
up.
skinny guy.
I just care about being fat, eating well, and just lifting a lot.
He's really skinny.
It's good for your mental health.
But he goes up to people. He pranks people. He goes up to people as a gym cleaner and pretends like he.
I've seen that. Yeah, I've seen that.
It's
Someone
very
And
sent
he
it.
just fucking.
Someone
200
sent it
kilo.
to me. Yeah.
Powerlifting is actually it's very good.
Yeah, it is
It's
very
very,
good.
very good.
Some Iranian jeans.
Well, what are some values or principles that you live by? So, like, genuinely, gym and all of that good stuff could actually fit into this question. And how have they helped
The
you?
only value. No.
It is mine.
Lift heavy, eat big. So I would say that, like, I always, and this is really annoying, and it's definitely like held me back at times. We talked about kind of long-term vision earlier, right? I would say I always try and do the right thing, even if it, like, no matter how much it kind of disadvantaged me in the short term. I always want to know that I've done the right thing in any situation. And I think that, you know, I've said this to people, and I'm sure someone will prove me wrong, but, like, I'd like to think that if anyone close to me kind of watched a, like, literal, like, first person video of my entire life, that there'd be nothing in there that I'd regret people seeing or kind of, like, feel ashamed by. I think for me, like, I feel guilty about a lot of things, like normally when I'm not doing things, but I never want to do something where I regret that action, that decision. Now, I know you talk about regret minimization framework. I'm not talking about like business decisions and stuff. I'm talking about kind of how I live my life day to day. So I think that's number one. Like, I want to make sure that I'm like good, like really kind of through however I do stuff. I really try and kind of prioritize, and I say this because, like, the reality is it doesn't happen, but like health, well-being and all the rest, like, just matter more than anything else. And that has to be, for me, that has to be the case because so often that isn't the case that I have to pull myself back. So, for example, I had burnout 2020. Obviously, lockdown didn't help.
Everyone had burnout.
But like 2021, I had it, and I was actually signed off from work for 2 months.
Oh, really?
Like bad, but like my brain didn't work. It was very weird, very scary. And I'm used to kind of being sharp and functioning. When I was like, I got to the point where I was reading an email, like the same email, like 5 times, just wouldn't go in. And like it's scary because like you're used to being able to kind of work hard through everything and just keep going, and you realize that like ultimately if you don't have your health, you can't do any of that stuff. So
I agree.
I do put it first. I try and go to the gym a lot. I try and eat well. I try and sleep 7 to 8 hours a night. And I say I try because it's like ultimately work often gets in the way of at least one of those things.
Yep.
And that's fine because actually like in the short term, the most important thing I'm doing right now, apart from my fiance, I love you, hi, is Sprout. But if you don't know what your actual priorities are, then they'll just start moving further and further down.
But the main thing is you still acknowledge you have the consistency in the gym. You might, let's say, important meeting gets in the way, but you're back in there the next day or the day after. But a key point that I also want to outline is you being in the real world, like being a founder, especially actually VC-backed founder, or you've raised money basically. You have a fiduciary. You basically, the money is not yours. That money that you've raised is not yours. So it's even tougher. There's more on the line, more accountability on the line, reputation risk than someone who's bootstrapped and just can go to shit. So
yeah, like I'm not the most important thing.
Yeah,
right? Like that's the really weird. Like I have someone said to me the other day, they were like, you know, it must be amazing no one tells you what to do. I was like, everyone tells me what to do.
Yeah, so
like I'm, you know,
hats off, ultimate skin in the game. And my point with I had to do that. My whole spiel with another pun. Whole point with all of this is that as a I'm sure when you're in the corporate world, like it's easy to like go to Arsenal games and be in the gym and have a social life. Like before the podcast started, you were saying to us, and you know Iman better, you're saying to Iman, how are you handling, you're going to work, you're doing the podcast and syndicates and writing and distribution, all of this shit, you've got a relationship, you've got obviously family and stuff. There's a bunch of other stuff you mentioned. I lose track of all the shit that we do. Like my brain's in overdrive at this point. Sleep,
eat well,
go gym, all of this stuff. And on top of all of that, like in the core, for us, it's like, okay, it's a side project, and then you have your day careers or operating jobs or whatever. But for you, it's ultimate skin in the game. And I think, correct me if I'm wrong, when you're in corporate, even if you're doing 10 side projects, it was much easier because you have the stability, or it's just very risk-free anything you do. But when you're skin in the game, like now, you're kind of, it's a different type of stress, but your cortisol levels are higher. And so that's why gym is never an ultimate priority. That's why for me, like when I was in corporate, I was I lived in the gym. It was easy. I slept, ate, social life, very low stress. The work was intense and I did well, but it was low stress. But when you go skin in the game in the real world, the pressure, I guess maybe the tribal instincts kick in of, if you don't do well, your reputation will either be fucked and you're disowned. It's maybe deep in the evolutionary psychology, whatever. You'll be disowned, or you'll lose the roof over your head. Like your brain goes into fear mode. Yeah. And so the stress compounds and the cortisol, like...
Which is why it's even more important to get back in the gym, right? So I think the thing that rides the top of all of it is knowing that I can't build Sprout into what it needs to be if I'm unwell, if I burn out, if I whatever, right? And therefore, like it's part of, you know, if you look at a professional athlete, right, you're peaking on match day, right, you're peaking whatever, but recovery is part of that. And for me, it's about knowing it's not all essential, right? Like you can have a couple of nights of bad sleep, or you can not go to the gym for 3 days, or like, you know what your limits are, but it's about kind of optimal performance. And I hate saying that because that sounds really douchey.
Optimize.
I don't in fact I want to walk back that. It's about just functioning, right? It's about functioning well. And therefore I need to know what matters to me, and I need to know what allows me to do what I need to do with Sprout. I think what I would say the difference between corporate and where I am now is I have way more control. I have less freedom, but I have more control. And what that means is basically I'm always working if I'm not doing something, but I have the ability to do the things that matter to me.
Yes.
So I have the ability to go to the gym when I want, because I can move all my meetings around that. I have the ability to go to every Arsenal game, even if we lose, because the difference is those hours on the weekend when I would have sat on the sofa doing nothing, I'm working then. So it's actually really important for me to know what matters in my life, because if I didn't have those things, I would be working 24/7 and it just wouldn't last. Whereas having the things that matter to me, like downtime doesn't matter as much to me. Like,
me too.
It doesn't.
I don't know what downtime is.
Yeah.
But
downtime is rational and 50 other projects.
But those are hobbies, right? Like ultimately, like the other
But
thing
it's
is
not Netflix though.
No, but what I would say is I learned when I had burnout, I learned that there's a difference between physical and mental rest, and you can get them together. So like if I'm exhausted from work, that doesn't mean I'm too tired to go to the gym. It means I'm too tired to think. And if I'm exhausted because I haven't slept enough, that doesn't mean, actually sitting on the sofa working might be fine because I'm physically tired, but I'm mentally rested.
Yeah.
And it's about understanding my body to the point where I can kind of, on any given day, I know what I need. I know I need a lion. Like tomorrow I need a lion.
Yeah.
But also I don't have plans during the day, and I know that I've got some work I want to get done, but I know that I don't want to do anything on Sunday.
Well, it's because we grilled him.
Well,
He's going silent.
Don't worry, I've got plenty more to do tonight still.
well, look, it's been I don't know how long we've been rolling, in 2-3 hours.
5 hours.
Yeah, 2.5
I've
hours.
actually
This has
call in
been-
an hour.
This has been he's got a call in an hour. We have a huge feast in an hour. But this has been a blast. It's been a pleasure, and I'm sure we will bring you on again. Let's say in 2 years or whenever you've grabbed 50% of the market or some crazy figure, which you're on track to do. So, any last thoughts, remaining words, anything you want to leave people with? Anything left?
With that, before I plug Sprout, obviously, because I
Yes.
haven't done that yet. I would like to. We've said so much that I'm sure there's certain things that I would walk back if I could, but I can't remember what those are. So if anyone's thought I've said anything really stupid or whatever, let me know, and I'll let you know if I stand by it or not. But this has been fun. I feel like we could do this for a long, long time. I try not to be too opinionated normally in my kind of Sprout hat world, because you've got to be really selective when you're opinionated as a founder.
You're serving your customers as well, right?
Yeah, like this is,
here you're giving my opinion. I'm serving myself and the rational brand.
this is not me digging you out, right?
Yeah,
but
of
like
course.
it's easier for you
Absolutely,
to be opinionated
absolutely.
in the world you're in. Whereas I'm like, if I and we will do this at some point, right? Like I want to share strong opinions on EIS funds. I want to share strong opinions on angel investing. But there's a time and a place.
Yes.
And I think starting point is it's really weird, because I want people to know the Sprout story.
Yeah.
I want customers to Sprout. I want funds to know us. I want funds to know us as people.
Yeah.
And it's balancing all of those things. Like I've tried, it's been really nice coming on here and like shooting the shit a bit.
Yeah.
I'm sure I'll have stronger opinions when the cameras are off, but like this is great.
Yes.
Because actually, there's not a lot of good. We talked about content. There's not a lot of good VC content.
Yeah.
Like it's a starved area.
It's normally tell me your LTV to CAC ratio, or just basic shit like that. But
Yeah. And then tell me how you calculate CAC, and I'll tell you why it's the wrong. That's another conversation.
What's your morning routine?
I get up at 4. I go to bed at 5 a.m.
There we go.
and then I get up at 4 a.m. and then I have an ice bath.
And then you look at the sun, as Huberman tells you to do, and
I
the day's
actually
over.
I go for a bike ride whilst I'm in the ice bath, and then I have just
Optimize.
oats, just like uncooked oats for breakfast.
Optimize.
I eat a raw steak.
I do 5 hours of work before 7 a.m.
Optimize.
because I can't. Yeah,
Well, look, with all of that being said, exactly as you said, it's easy for us to sit here and be opinionated, but as I said, I take my hat off to you, because you have the ultimate form of skin in the game. You are, as Roosevelt says, the man in the arena, and we like what you're doing.
Thank you.
In fact, we love it, and we hope, and I'm sure we'll see you back in a couple of years with exponential growth, not in just in numbers or revenues or whatever, but in everything and every way. So
Thank you.
It's been a pleasure. It's been a blast.
Pleasure. Thank you.
I look forward to your plush podcast studio next time.
Viasprout.com. You always got to plug the domain. Viasprout.com. Ladies and gents, Jonny Blausten.
Cheers.
Thank you.